Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, first of all, welcome. Second of all, be sure to check out all the content we put out onto the internet. Follow me on Twitter, which is at Focus Compound. If you're watching us on YouTube, hit that subscribe button. And if you are listening to us on Spotify or iTunes or whatever other podcast app you listen to podcasts on, be sure to check out all of our content. You can go to focuscompound.com. Geoff Gannon actually wrote up a piece for Focus Compounding that was uploaded yesterday. Didn't you, Geoff? Mm-hmm. And you could get access to that if you go to focuscompounding.com. And you do have to become a member, which I am not signed in. But your title was Don't Just Over Maximize One Variable. Find stocks that tick a lot of boxes at once. Mm-hmm. Do you want to tell the overall theme of this article? I guess the title pretty much says it pretty good, covers right? It,
yeah. Uh-huh. So it just talks about, because we were at the Willow Oak event and you were asking questions of the panel. I was on the panel there. And one of them was, what do we wish that we'd learned earlier, whatever. Actually, it wasn't your question specifically. It was actually a question for the audience, right? Wasn't it?
I believe so, yeah.
Well, there was a question for the audience about that. I think that's when I brought it up. But, and so I just talked about like not buying something that's necessarily the very lowest PE or the highest growth or the whatever it might be, but instead looking for stocks that have a few different things working together for them. Because people seem to be most interested in, like, say, value stocks, right? The cheapest. Mm-hmm. So they want that 5p instead of 7 or whatever. And that's kind of what the article's about.
So instead of buying like the 7 PE that also may have a great business attached to it, people convince themselves of, but this 4 PE, it's just so dang cheap. Mm-hmm. And you had said that if you could change one thing about what you have done throughout your career is don't just focus extremely on one variable.
Right.
Sort of find a company that has both things going for it.
Mm-hmm. We talked a little bit about that with value stocks and just saying, like, in general, that if everything that you buy is maybe, say 12p or lower or something, right? Then you're a value investor just by them doing that. And so you can spend the rest of your time finding the best stocks that are at those prices rather than necessarily having to look at a screen for the very cheapest or something. Because sometimes people ask questions about like the magic formula or something. That kind of thing isn't really my favorite for that very reason. People kind of cherry pick from it and they do it based on like what has the very highest return on equity, what has the very lowest PE, things like that.
That's sort of been a known thing as well, right? That the people that have not had success with the magical formula, it's been because they cherry pick which companies to buy. And Joel Greenblatt was like, you can't do that. You need to just kind of shotgun it and keep like a, systemized approach to picking the stocks, basically. I think he said like hold them for a year and then you just reshuffle the deck.
Yeah, I think that makes sense. I think from like I talked a little bit in that article about like quant type things. That kind of stuff works for that. Of course, Buffett's approach is kind of magic formula, but basing it on trying to judge whether there's a moat and buying only those. So it really does approximate, I think, how Buffett approaches stocks. It's just that it's a diversified, quantified approach instead of his focus on by actually analyzing the business.
I would love to hear if there's an investor listening that has followed the magical formula for their own personal investing and have not used it from the perspective of just trying to cherry pick ideas. So if you truly followed it the way that Joel Greenblatt laid out the rules, I would love to hear how your results have been and what your experience has been. And that would be interesting to hear about.
Mm-hmm. Yeah.
If you had to guess, what would you say?
I don't think many people have done it. I know that it had some years that weren't so great versus the S&P for people. So that's part of the difficulty. It's sort of like with nets. I feel the same way. Where we try to come up with lists. And then what would happen is I don't really like using those lists because then people would pick out certain ones that they like the best. a lot of times they pick up either with the magic formula, I think, or with nets. They pick ones that they think have the most upside, or that they think is the right time to buy them, or something like that.
Mm-hmm. Interesting. So in today's podcast, we are continuing on. We're going to aim for an hour and a half. People like the longer form podcast. What I'm going to start doing is just kind of put together just a little slideshow of things that I thought I want to go over on the podcast and use it for the show. And we're going to always hit on the markets, and then we'll do a topic, and then try to connect with our listeners by going over emails. So if you want to email me and you have a question, email me at andrew@focuscompounding.com, and just in the subject line, put podcast, and then I will group it and sift through a few to go over on the show. And I think it's great because it's easier to really just go deeper on some ideas as opposed to tweets and stuff like that. So where we sit today is May 17th, 2022. The market is down 15% year to date. I think last time we recorded, it was down maybe 17%. So we are officially traders. Now, Geoff, talking about short-term market movements. The 10-year yield is still basically right where we recorded last week at 2.948%. The one thing that's kind of caught my eyes recently as well, and a lot, probably because we've spoken a lot about Buffett buying Occidental. Crude oil is at $114 per barrel, and natural gas, that's been the biggest move, is at $8.23.
And it's been less of a move in the U.S. than in other countries, actually.
In other countries, it's like, what, $60 or something crazy like that?
It's a lot, and the move has been much bigger in other countries. It's but still, it's up almost 100% from, actually
basically year to date, right?
When you asked a question on an earnings call of a company saying what would happen if natural gas doubled or something, it's basically about doubled from there. The end of their last fiscal year. So yeah.
What are your thoughts on that? I mean, so we spoke a little bit about last week how Occidental on the earnings conference call, they're talking a lot about capital allocation. Mm-hmm. You think that's probably the main thesis for Buffett buying into the company. I've listened to a lot of other oil companies. They're all speaking about capital allocation. It's all about, no, we're going to buy back our stock and pay a dividend. Mm-hmm. I think oil prices could be here for some time. I think a lot of oil, and this is just my opinion, I think a lot of oil companies are worried about their terminal value, right? Because of ESG, because of the decline, because of the switch to renewable energy over the next 10 to 15 years.
Yeah.
So I just wonder if they're going to be more reluctant to spend all that capital to go and increase production, do all those different things. And this time around, focus more on capital allocation, which could keep prices up. I mean, at some point, I do think greed will take over and they will go and put capital to work. But to your point about Occidental and Buffett's thesis, and to my point, after listening to a decent amount of conference calls, it seems like a lot more management teams are focused on capital allocation this time around. Mm-hmm. So I thought that's kind of interesting. I was looking at the rig count, and you could see, I mean, talk about, so I'm planning a podcast that we're going to do on consolidation and just go over like the railroad industry and all these different industries and how they all start out and then how they are in the present when the industry becomes much more settled. Like I found this cool chart that I wanted to show that shows like the scaling chart and then like when consolidation starts to happen and really when we start to focus on the companies. Mm-hmm. So I think it would be cool to do a podcast on that. But like rig counts have declined over time. Like you could see from like a long-term trend, the consolidation in the industry. And this is nothing groundbreaking or new. But I think higher oil prices, I don't know, but I think higher oil and gas prices are probably going to be around for longer than people think this time around. I think we're in sort of a secular bull market in that market.
Maybe there hasn't been a lot of growth in the supply things in the United States, certainly. And there's some growth in when we're talking about natural gas and things like that in export and demands from other places. So it's possible. So far, that's been true. We'll see if that changes. But the price increases, basically you had inflation. So you had like money supply growth and speculation based on that. But then you had supply not come in a big supply growth. It hasn't really been a surprise in demand. So,
and then you have everything going on overseas, which I guess leads the market to be less certain, I would say. They're pricing in a lot of different things.
Yeah. Yeah, that's a possibility.
So you wanted to talk about Berkshire's 13F that just came out recently. We're on Dataroma for people watching on the screen.
And for some of these things, we may know additional information that isn't captured by this filing because the filing date is for the end of March, correct?
Yep.
So sometimes you might know more about it because he passed some threshold with a company or something like that. So more information has been revealed since then. Like we probably know he has to own more Activision than I think it shows there because maybe. I'm not sure about that actually.
$5 billion?
Yeah, he owns just under 10% of the company, right? So I think that filing isn't up to date on that. But so you see, for instance, Chevron. So Chevron's even a much bigger position than Occidental.
$25.9 billion.
Yeah. Obviously, he likes the oil things with both Chevron and Occidental. Chevron's not a new position, but it's a huge increase. So it's effectively like having a new position, in terms of how much he bought. What I meant with Occidental about the capital allocation plans is really that he had owned Occidental before. And so why did he go back into it and everything? I think that specifically was something that he thought about. Capital allocation, which he often does, that's often his reason for why he buys the stock at that moment. But obviously he follows these things and has an opinion about prices, and
Yeah, it's still not back up to its 2011 high of $109 per share. We're at $67 today.
Yeah, and a lot's changed with the company since then. Obviously, I think part of it is, it wasn't a very popular deal that Buffett helps finance and everything. So
he knows the company well. He's been involved with the company for some time.
Yeah.
And do you think it's just he's betting basically on higher oil prices and capital allocation?
I think he's long thought that oil prices would be higher in the long run, and there'd be a lot more free cash flow than people thought. He's kind of said that, when he's talked about it, he doesn't know exactly what the price will be, but, he thinks there'll be a lot of profit in some of the last barrels of oil taken out. It's very hard to predict industry, like even where you were saying that they might be concerned about their terminal value and everything. The irony with that is if the industry as a whole each individual company behaves that way, then actually you end up causing that transition faster. Because, of course, you drive up prices to make them less competitive. Mm-hmm. And people become concerned about it. You have much more conservation. You have all sorts of things if you have oil prices that high. Whereas if you manage to keep them lower, but not too low, you'd be better off in the long run that way. So,
is there anything else from the 13F that stood out to you?
Oh, yeah, there's several other ones. So we know about some of them because he said it or we kind of heard about it before. But definitely one, we've talked about entertainment stocks. It's very interesting that they bought a huge amount as a percentage of the company of Paramount.
Paramount. That wasn't
so that's Viacom CBS is its former name. And of course, those two companies split apart at one time and then came back together and all of that. And they had a different name, but they've renamed recently because they have Paramount Plus as the name of their streaming service. So I think that's why they chose to rename it after the movie studio, which is not really the biggest part of the company. It's CBS and Viacom, so the cable networks of Viacom with CBS, the U.S. TV network, as well as actually own TV stations too. And the Paramount Plus is the streaming service's name, and Paramount is the movie studio's name, obviously. It's a major movie studio. We talked about it. It's just a bit smaller than the very biggest majors. So it's almost kind of the smallest of the major movie studios at this point. And then it has the streaming service, which is, we'll see. It is a question of whether it ends up having enough scale over time. It's one of those that we talked about that we're not as sure as like Netflix and HBO and Disney Plus are the ones that you're sure about. The ones you aren't sure about are Paramount, Peacock, and ones like that. And Sony had one and they don't anymore.
Do you think this is Buffett?
It's interesting. I think it's of a size that it might not be Buffett.
Yeah, because it looks like, what is it, $2.6 billion?
Right, but that's huge then if it's not Buffett. So, right, the two of them together managing maybe $30 billion. Do we have an idea of exactly how much they're managing?
If I had to guess, I would say, yeah, about that.
Okay, so
combined between the two.
Right. So say it's one person doing the buying. So, combined, each of them might be managing around $15 billion, less than $20 billion, let's say, one person. This is a purchase of over $2 billion?
Yeah,
over $2 billion. So more than 10% of one person's portfolio? Probably. I think it's very possible it's someone else, that it's not Buffett. But we don't know that. But if it's someone who isn't Buffett, if it's Todd or Ted, then it's a very large purchase for them. And they don't have a lot that are above that. You can see that what of those above it are probably not Buffett. They're very few.
Mm-hmm.
Most of them we know probably are Buffett, or I would guess are Buffett. DaVita's not, right?
Yeah, DaVita Healthcare Partners.
Right, which is a huge position.
HPQ, do you think that's Buffett as well?
It seems more like Buffett, to be honest. And it also seems like Buffett but who knows? It might not be, but I always thought that was probably Buffett. But we've known about it for a little while.
What about Amazon? Who owns Amazon, if you had to guess?
That's not Buffett.
Ted? Todd?
Know. Snowflake's not Buffett, Most everything below there isn't Buffett, I would guess. He's not Charter. He's not Liberty, not Visa. So none of those. Sometimes it's interesting to look and think, well, could we be seeing something that he started buying and we wouldn't really know? But I don't think so. I think that what we're seeing above that is not. There's some where I've never known. Kroger is a good example. We've seen Kroger for a while and stuff. Who knows? It's kind of like it's too small. It's too small for Buffett probably.
Yeah. Mm-hmm.
But then it's a very large purchase for someone else. But was it ever possibly going to be an even bigger amount? I don't know. But it's a pretty big part of the company. So those are all interesting. Activision we know was not Buffett originally, and then it is Buffett now as an arbitrage thing. Citigroup, which we didn't talk about yet, presumably that's Buffett, but we don't know that the others don't buy financial things. It's just that is probably Buffett. And Berkshire hasn't owned Citi before.
I think financials are a good play in the current market.
Citi's incredibly cheap.
Yeah, I was going to say, I was looking at a lot of them. I'm like, okay, so financials have gotten slaughtered through the recent downturn as well.
We're talking about the two cheapest industries right now.
And
financials and energy are the lowest.
And it's become
Ps.
Nothing but a better industry for them. I mean, now presumably people will say, well, if there's a recession, that's not good for banks, and I get that, but
they could be that
they're pretty damn cheap.
People could be worried that oil prices will come down a lot. They could be worried that yield curve will invert and things like that. So there could be real good cyclical reasons why they don't like financials and energy. They are, however, the two cheapest.
We haven't spoken about this, but like I've said, I mean, we're not traders, but it's been surprising to me the price in energy, a lot of energy related things, and the price of a lot of financial related things that have gotten brought down through the recent downturn.
Now, part of that though, as you've seen even in some stocks that we own and stuff, is actually not due to the prices coming down. It's due to the earnings going up quite a bit without much gains in prices beyond what other groups are earning. So that's whereas like if you compare that to consumer things, right? So like some consumer stocks are probably the most expensive groups, but it's not just that their prices went up a lot. Obviously, tech things had their prices go up even more in a lot of cases. It's also that their earnings didn't go up that much during COVID and all of that, So if you were something that went up a lot during COVID, your earnings, and that has, actually even more recently, some financial things, their earnings have gone up a bunch. Certainly energy things, they've gone up a lot. And so it's easier for them to end up with really low multiples. Also, they just average lower multiples for a very long time, as you know. Energy and financials have both been some of the cheaper groups for probably the last decade. And they continue to be, even when their earnings growth is higher than other groups now.
Mm-hmm. So Citigroup, we have it up on the screen on QuickFS.
Terrible long-term results since the crisis for them. Their returns, barely grows. The return equity has been poor. They have disposed of some things. So that kind of makes their growth misleading that way. And it's not as U.S. focused as what Berkshire and certainly Buffett normally focuses on. Buffett's investments, especially in financial stuff, is very U.S. focused. And Citigroup is not so much U.S. focused. Of the big financial companies, it's the least U.S. focused, really. If we put aside things like the, we don't count things like American Express and the, other companies in that group. Berkshire actually owns a lot of American Express. So putting those aside, just looking at big banks, they do a lot that's outside the U.S. And they have pretty weak sort of like U.S. retail presence and stuff compared to the other kind of companies that Buffett would buy into. So we don't know it's Buffett. But if it's not Buffett, it's a pretty big purchase from someone else. And we haven't really seen a lot of financial purchases from others. There also is an insurer bought in small amount too, right? Markel appears on there. So from time to time, you might see other things. I thought Markel did, but I might be wrong.
Yep, you're right there.
Yeah. So Ally, that definitely seems like something that might not be Buffett. That seems of the size and all that. That's not.
We've gotten asked about that company a few times, haven't we?
Yes. Mm-hmm.
Floor and Decor. Someone's up in it, but still, I mean, that's not Buffett. $387 million.
Yeah. So the answer, I mean, Citi stood out to me because it's either a very big purchase by someone that isn't Buffett and they're about complete with it, right? So what's the dollar value of it at this point?
$2.9 billion.
Right. And what's Citi's market cap?
Citi's market cap, $92 billion.
Okay.
So yeah.
And so you could buy about $9 billion worth of it at current prices. If you're Berkshire, it doesn't pose a problem as long as you don't go over 10%. And if we look at the business description, let's see what the share turnover is. Yeah.
330%.
Mm-hmm. And I think it would not be hard to buy a lot of it. So it easily could be something where you're capturing a very early part of them buying into it and that they intend to buy a lot of it. He also finally officially got rid of the last of the Wells Fargo. And there's been other things. Let's see, what else did they sell?
Verizon.
That was, we don't know. That definitely could have been Buffett. I've never known who that was. Some of these I wonder because I wonder like if they were intended to be larger. Mm-hmm. It makes some sense if they were possibly. I don't have a good feel for the other two portfolios outside of some of the very biggest positions we've known about for a long time. But Citi could obviously become larger if they wanted to. Mm-hmm. Berkshire could buy a lot more of it. And it could be a meaningful position. Whereas like Kroger is quite a bit smaller than Citi, so it'd be hard to do that. Citi's of the right market cap sort of category.
So if you had to guess why Buffett sold Wells Fargo completely, is it because of the whole scandal and everything that happened? Yeah.
Yeah, I think so.
That's crazy, man, because that's a bank that they've owned for quite some time.
Yep. And some of the purchases did really well. Some of the other timing the purchases didn't do well. Kind of an okay investment overall for Berkshire over all those years, but they bought into it at a bunch of different points.
Mm-hmm.
Yeah.
Interesting. Speaking of share turnover, if I could go back to my presentation, Cassandra B.C. That is at Michael J. Burry on Twitter. He tweets and then he deletes.
Oh, okay.
He'll delete the tweet like an hour or so later. But I thought this was interesting because we're talking about share turnover. He said from top to bottom, Microsoft traded 5.2 times its shares outstanding by 2002, 3.3 times by 2009, and then he compares it to where we're at today, only about 0.5 times have traded. Amazon traded 5.7 by 2002, 6.6 times by 2009, and 0.9 times so far. JP Morgan traded 3 times by 2002, 5.9 times by 2009, and about 0.7 times so far, etc. Enough takes time, which I thought was interesting because like the move of things and how I guess you could say like the excess drains out in the market. A lot of times that takes time. And there's a lot of people that I think forget that. You go back to 2020 when we had the COVID crash and just how quickly things rebounded in the market. I thought that was interesting. Do you have any thoughts on that?
No.
No thoughts on that. Okay. So another thing that was current in the market, have you been following the whole JetBlue thing? Is this a potential ARB? We've been talking a lot about ARBs lately.
There's a lot, right? So, because you have huge spreads on Activision Blizzard, on Spirit. Let's put it that way. So Activision, Spirit, and if we do the targets, Activision, Spirit, and Twitter all have very large spreads with suspicion that deals won't go through and stuff, but not with a lot of belief that the deals are crazy valuations.
Somebody said on Twitter, they asked if we could go through more special situations. And a few people were like, they have the past couple of podcasts. They've talked about Twitter. They talked about Activision. I'm like, here we are. Now we're talking about JetBlue and
these
Spirit.
Deals are so big too that it does make me wonder if something is unusual about why the spreads are so big for some of this.
So what does that mean? Unusual how?
Spreads aren't normally this big. To say that they're pricing in that a deal won't happen is when we talk about something like, say, Activision or Twitter is a good example. I guess that's an easier one mathematically for people to think of. That is a gigantic spread for a deal unless you're really certain that it's not going to happen.
Dude, the ARB guys in Twitter had to have gotten smoked so far.
Well, what's the price versus where it started? I mean, so we're
back to
before it was announced, right?
This is like right here. Yeah, right when I believe it was announced.
Yeah. I mean, Activision has been back to about where it started out. In terms of you could have bought before the deal was announced. And now they were working on the deal, presumably at lower prices, so that's part of it. There you go.
Mm-hmm. And what is it for $95 a share?
Mm-hmm. Yeah.
That spread is just huge.
Mm-hmm. So these are very large, and they're also very big deals. It's very easy to trade the stocks. When we talk about other sorts of things, we mentioned like, Cambria or Hunter Douglas or whatever. There's a reason why there's a spread in things like that, or there even wasn't much of a spread, but why you'd think why it would seem really obvious there'd be a higher offer, but people might not be buying it. It's just totally illiquid. And super illiquid stocks may sometimes attract investors in them, but they don't attract people who are trying to do arbitrage stuff. So that's in very big stocks that are very liquid. That's why they do it.
Do you have any thoughts on Twitter? I mean, so now, just to update you, because I don't know how much you follow the whole Twitter thing going on right now. Elon said that the acquisition is on hold.
Right.
Because he doesn't believe that bots represent 5% of the company. Now, He signed a definitive agreement, and he did waive due diligence rights and all that sort of stuff. And now he's openly doing this in public. I mean, I guess if you were his lawyers, on one end, you'd probably love it because this is going to be a huge thing. On the other end, you're probably like, Elon, what the hell are you doing? He was at a technology conference yesterday, the All In Summit, basically talking openly about this.
Mm-hmm.
That's crazy to me. That is insane to me.
Why?
Just because he's openly talking about the Twitter acquisition. They're not closed on it. He tweets and is saying this is on hold.
Right.
He signed a definitive agreement. He waived due diligence.
Now
his argument is that
the problem is, this is the issue for Twitter. The issue is that this is with Elon Musk, who's going to talk in public about stuff that was always going to happen. So you knew that when they started doing this. The problem for Twitter is the due diligence stuff doesn't matter because they include information about this, as do other online companies, in their filings, and they're probably not accurate. And it's known that probably Twitter, Facebook, these companies put stuff in the filings that's probably not correct.
That's what his argument is.
And that's
He's
a pretty
saying I was going off their
issue.
public filings.
Right. And now someone else could say, well, everyone knows that this has been questionable. Yes, they can't really rely on what's in the public filings.
He said he's not worried that he buys the company and bots represent, like a little bit more than 5% or 10%. Mm-hmm. He said that he's worried that he acquires the company and bots are actually like 80% of their user base. There are so many bots on Twitter. So many bots.
Yes.
Even we get so many people that DM fake accounts, respond to just different things. And I'm like, this is clearly a bot. I just block them.
Yeah. Now it's, this gets very complicated. Twitter allows automated stuff, right? So first of all, in theory, a bot is not allowed by Twitter. Secondly, some things that people think are not real are in fact duplicates of other things that are the same person but are real. I mean, this happens with other things, Facebook and stuff. It's not just that they're fake accounts. It's that people have multiple accounts and they're sometimes getting rid of someone's intended to be genuine account and keeping the one that isn't real or that they didn't intend to be real. And I'd see the same issues here. I doubt that they can measure it all that well. But I also should say from an advertiser perspective, because people always argue, well, that's the issue for Twitter and that like Elon Musk needs to know because otherwise he doesn't know what the value is to advertisers.
That's what he said. He's like, if this business model is entirely on advertisers,
right?
How do you know?
Yes, but the only reason that people use Facebook for advertising and stuff, for companies, is because they can actually measure the results. They're not going off. They're not trusting that Facebook is correct in what it says. I mean, for newspapers for a long time have had things where they have very incorrect circulation numbers. This goes back decades. Local newspapers have had very inaccurate circulation, paid circulation stuff. Why do advertisers not really care? They don't care because it's very easy to say, let's just run the ad in Seattle. Don't run it in Portland. Have a company that does research on consumer stuff on actual shopping, measure the result in the two markets, and then we see how much sales it drove. What matters is how much sales it drives, not how many people saw it. That's true for all kinds of advertising. So although they talk about Super Bowl ads, how many people watched it, the ratings that they have for it, I mean, you could programmatically insert things into Spotify stuff and say, how many people did you reach? You could reach a huge number of people. It won't move any needles, and they know that. And so they won't pay for it. So I'm sure if you're running a Twitter campaign as a major company, you're going to do research that's going to show you what the effects of that is. And that may be part of the reason that Twitter doesn't have a lot of revenue. Relative to what it says it's its base of users. Why I can't monetize it that well is because maybe the ads aren't very effective. They might not be effective because there's bots. They might not be effective for lots of other reasons.
A lot of people have used sort of compared it to, it's like buying a house, waiving your appraisal rights, and then finding out that there's potentially a ton of termites in it. But that's why it's been sort of hot topic. I mean, part of me kind of wonders if he doesn't want the deal to go through. He had an excuse to sell $6 billion of Tesla stock without crashing Tesla.
Right. And there's
was this a way, sort of like a 4D chess move to free up some liquidity in Tesla without?
And he also put the company in play. If he really cares about free speech and stuff like that, then someone else could take out the company.
Yeah. Mm-hmm.
So, not that the company had much in the way of defenses against anything anyway, but it certainly may have a hard time continuing as an independent entity.
Do you think a lot of social media companies, they don't want to put out the real bots, the real amount of bots, because A, they don't know, and B, they do know, and they just don't want to cleanse it and have it all out in the marketplace at this point?
So all these companies put out information that's incorrect, and that's to some extent known to be incorrect. It gets repeated everywhere, and that's wrong. I mean, we're in podcasting things. We know that Apple has very incorrect data on podcasting stuff. There's better data kept by other people about it. But because it's Apple, people will say, go with what they, them as the definitive source, even though in some cases we know that they're counting duplicated things and stuff like that, and other things solve for that. So I have a suspicion with Twitter based on some replies from the CEO that the company, this is tricky, but I think the likely answer is that the company will hit a number that's like 5% or something based on how it chooses to measure.
How they calculate it?
Well, I think it's worse than that. I mean, my guess is, I think it may even be a target that they want to have less than 5%. And then they have a method for determining how, for checking what this is, which probably involves humans, but may also involve other sorts of things. And if you don't have an objective method that's being used at different companies, and you have a target that you want to hit, then you may hit that target. This is true for lots of companies. If we all use the same, net promoter score, something that's standardized between companies, and someone else applies it, then there's some reliability in using that figure, or you have someone else doing surveys for you. But if you come up with a method, and that method may be changing all the time, and I suspect that Twitter probably is. So they probably have not consistently used the same method for determining the percent that are bots, even from quarter to quarter, year to year. It probably involves a bunch of different statistical techniques that they use and different approaches. The sample sizes have probably changed over time. Different things that they've used. They probably use subjective parts to it where a human makes a decision on whether this is or isn't a legitimate account, things like that. And if they have a known target that they're trying to hit, then they may come up with that target no matter what. So it's fine. I mean, that's what a lot of companies do. It may be helpful for them to measure it in some ways. It's not the best way of doing it. Turning it over to someone else to do the measurements is the correct way to do it, but companies don't want to do that. I'm sure they'll argue that they can't do it anyway, but it's not really true. But they can't do it for privacy reasons and things like that, but that's not true. So, I don't think that we will get an accurate answer for that for any company.
Yeah, maybe Twitter won't take that route as well, so the deal will just be on hold forever. My whole biggest gripe with it is I like Elon, but I just don't think you should be able. I mean, this will just prove that like he's bigger than the system, and I don't think any person should be bigger than the system. And there's a lot of people listening that have followed Tesla over the years and probably say, "Hello, of course he's bigger than the system. Everything that has happened." But I don't know. I just don't think he should be doing this in public like he is.
Well, if you offer to buy a company, you don't. You pay a breakup fee for it or whatever.
$1 billion. Yeah, pay $1 billion. He sold Tesla for $6 billion. Move on with it.
Yeah, and in all sorts of industries and things, people do that all the time. They pay 10% of something to have an option on something they never intended to exercise it.
I mean, quite frankly, I think Twitter's in a good position. Okay, so he pays them $1 billion. Maybe they sue him for some more stuff, and they go back to hopefully fixing their company because all their dirty laundry is aired out now. Yeah, maybe there'll be a new level of accountability that comes in. I don't know. I mean, to me, you ought to think somebody else would come in and be interested in maybe acquiring Twitter. I don't know. But
right,
their dirty laundry's been aired out.
Well, if people thought that was true, then you'd think the price would be a lot higher. Mm-hmm. If traders thought that was true, and that's true for each of these cases. If they thought there was any realistic hope in the case of Spirit or Activision, especially because as you can see, if you were in these deals. I mean, during the same time, the S&P 500 is down 20% or something. Yeah. Mm-hmm. So like I said before, it's something that's fairly uncorrelated, not totally uncorrelated. I mean, probably the value of Twitter to a lot of people is down a lot, even since the deal. Well, I don't remember the date when he did talk about the deal, but financial conditions have tightened a bit for doing deals.
I think we're right. I think this was the spike. So I think we're right where he announced it.
Yeah, well, I think that surge in volume is probably associated, right? Mm-hmm. Yeah. So when was that? That was late.
Looks like April, beginning of April.
Okay.
Ish.
Yeah. So
end of March.
Yeah. So I don't know how much his prices have changed for any of these kinds of companies. Twitter doesn't really make meaningful amounts of money. It makes some money, but it's basically not that different than like a profitless tech company that's quite large, and they've come down in value by a lot more than Twitter has.
He was able to sell some stock in Tesla without crashing the company.
And so what do you mean by that? That was the justification for doing it?
No, but I'm just saying from his perspective, not saying that's why he went through this with the intention of backing out, but an added benefit is that, he was able to liquidate a ton of capital of course, look, like people on Twitter talking about it, they don't make up the whole market for Tesla, but everyone's like, okay, if you sell some Tesla, it will make you more liquid so you could do this transaction with Twitter. So from his perspective, he was able to sell some stock in Tesla at insane valuations, which, by the way, he probably knows is insane. And the stock hasn't really, I mean, sure, it's gone down a little bit, but it's not like it's gone catastrophically down if you were to just sell to take some chips off the table. I hate using that term, but.
Yeah, I don't know his reasons for doing it, since the beginning that we talked about it. I think of the deals, Twitter's the one that's the hardest because I'm not sure if the value of Twitter might be a lot lower than to someone else, right? So it doesn't compare to Spirit and Activision that way.
But I do understand his argument, though, of, hey, I relied on their public filings, and I think their public filings are inaccurate.
Yeah.
Dramatically inaccurate, potentially. Let's take it to the mat and find out. I can understand that, but
Well, the ultimate argument is...
I don't know how much of that has changed since signing the definitive agreement. He probably knew all of this going into it, I'd imagine.
But whatever agreements you sign and everything, if there's no serious offer against you, you have a lot of freedom in terms of negotiations. I mean, the thing with like Activision or Spirit or whatever is that with Microsoft is realistically, there might be a lot of other people who were interested.
Mm-hmm.
And so there's a lot of danger that you might have to sweeten a deal, or that if you couldn't be willing to back out of that something else could happen. You might want to stop a competitor from taking over a company. A lot of people probably take a look at a company in situations like that. It becomes an attractive sort of prize to have. If that's not the case with Twitter, and he was the only realistic possibility for them, then, we're just talking about like whether he has to pay a breakup fee or something.
Yeah, $1 billion. What's $1 billion to him? It's lunch money.
Right. And it might be worth it to see if they'll say, okay, let's do it at a lower price.
Mm-hmm. So before we jump into JetBlue and Spirit, just to give a background on if you think this could be a potential ARB, Spirit previously rejected a takeover offer from JetBlue, favoring an earlier deal to merge with Frontier, which we did speak a little bit about on the podcast. Now JetBlue is going directly to Spirit's shareholders. They are going hostile to offer all cash of $30 per share, which is a 60% premium to the Frontier transaction. And that they did say they'd be willing to go to $33 per share if, I guess, Spirit provides some additional information that JetBlue wants. Currently, the value of Frontier's cash and stock for each share of the discount carrier on Monday was recently at $19.48. So this is a pretty big premium,
right,
to where it's currently trading. So we can look at Spirit right now, if I could type, and $19.63.
Yeah. So
they're offering $30 all cash, or potentially $33.
Except so, Twitter, the board is saying shareholders should vote for the Elon Musk deal. Here, the board is telling them to vote against the higher offer.
So how does that work when this is an all cash offer? So the current shareholders are going to have nothing to do with the merged company. So what's the better outcome for the current shareholders? It would be $30 a share.
Yes, if the deal.
But they're recommending not taking that.
The argument that they usually will always make is that the lesser value deal is more certain to close, and that if it doesn't close, then our stock could fall by who knows how much, and everything could be a disaster. Is that very convincing in these cases? We can look at quick FS and see.
Yeah, let's look at quick FS and see. What do you want to look at? JetBlue?
Well, we can start with Spirit.
Spirit. You ever flown Spirit?
No. I
have before.
I just fly Southwest.
That is true. You did fly American to Omaha.
That was my choice.
That's what Andrew Kuhn always flies. All right. Okay. Spirit Airlines, quickfs.net. If you do sign up, tell them you came from Focus Compounding. What do you want to see? The balance sheet? Income statement? What?
Yeah. So if we look based on past numbers and things, obviously not expensive, right?
No.
At all. So you have the long-term average operating margin. Now they've not generated a free cash flow, but the long-term average operating margin, you're getting close to 15%, something like that. And yet your price to sales, is at, 1 times or whatever. And that's not like an unusual sales level. So pretty cheap that way. You could look at other measures. It's hard to evaluate without knowing all the things about their balance sheet and stuff, things like price to book and stuff. They can be very misleading at airlines. But EV to sales and things like that will be much more accurate. And it doesn't look expensive. Okay. We can look at JetBlue.
I've never flown JetBlue.
So we can look at their... So this is what I thought we would see. They would seem, if we put aside the issue of COVID and say that happened for 2 years, capable of, in a normal market being able to finance a deal like this.
Sure. Yeah.
Yeah. Not that the deal's small. It's not.
No, I mean, what was the market cap of Spirit? $2 billion?
Yeah.
2.5 billion enterprise value.
It's very big.
And so JetBlue, they have a $3 billion market cap or 3.7 billion enterprise value, but looks like just eyeballing it from 2017 to 2019, maybe a normalized operating profit is like what, 850 million ish, 800 million.
Now the Fed is tightening. Financial conditions getting worse. That is usually where deals fall apart and where you can't get financing, especially can't get hostile financing. So a lot of deals, the spreads may be bigger and people may be afraid of things for that reason. That might happen in other environments too. That's something to keep in mind. Buffett financed some friendly deals during times of a lot of stress because there were deals that were going to happen and then they wanted to close anyway. And so they went to Berkshire. There were a couple of those. He did that with Dow, Mars, Wrigley.
So maybe a normalized operating profit for Spirit, maybe like 400 and change, 425 million. And then JetBlue, we say like 800 something million. So could you see them taking on a good amount of debt, being able to support like 2 to 3 times to do an acquisition like this?
I don't know, because I don't know things about leases and stuff like that. So it's really hard to tell. It's pretty dangerous putting on debt on an airline.
It's been proven many times over.
Well, I mean, just if the cycles kind of coincide for any reason, then you have a bit of a problem. So that's hard. I think there's also an added thing here with these 3 airlines that we're talking about. I'm not 100% sure, but I think there may be some added urgency with it because there may be the feeling that you will be allowed, any 2 of these companies would be allowed to merge with each other, but other airlines won't be allowed to merge with each other. So while larger airlines might be willing to buy any of these, they really would have trouble getting the deal done. And they're not going. And if you're the one who doesn't get to pair up here, you're never going to get a chance to be acquired by the 2 that do pair up or to acquire them or anything like that.
So because of antitrust issues?
Yeah.
Got it.
That'd be the fear. I don't know if it's realistic or not. Yeah. But it doesn't always turn out to be the case. But I think that is a realistic fear. I think that may be driving part of it.
So what are your thoughts on this? So you have said your favorite ARB situations are ones where you feel like somebody could come and pay a higher price than the current market, and the situations where you would be happy owning the business even if it doesn't work out. Mm-hmm. What are your thoughts on Spirit?
I don't know if I want to own an airline stuff. I think Spirit and Activision are both of them are very attractively priced from the perspective of possible takeover by people in the industry. But to be fair, in both cases, I think there's serious belief that regulators, and not just regulators, but that these are politically sensitive topics. I mean, you wouldn't think normally that Activision would be a politically sensitive topic. It's more Microsoft, but stuff that happened in Activision plays a part in it. But certainly airlines are always a politically sensitive topic.
Even little Spirit Airlines merging with little JetBlue or little Frontier?
I don't think they should stop smaller players from merging together when there's already several larger ones in an industry like this. I feel the same way in telecom, and eventually in telecom they allowed 3rd or 4th place ones to merge together to be a more viable competitor to 2 that were already much bigger in size. Yeah.
Interesting. So what's on most people's minds nowadays? We could go back to the presentation. Is profitable growth companies or unprofitable growth companies and the differences between the 2.
Okay.
We have an email from somebody. Again, email me at andrew@focuscompound.com and we will pull some emails and use it for content. It's a great way to do it. And sometimes it's better to email as opposed to Twitter. Put the subject podcast, andrew@focuscompound.com. So this question says, high price of sales, 10 plus, with promising future and strong moat. As Geoff said in the latest episode, he thinks that a price to sales of 10 should be the maximum in almost any circumstances. And I would agree personally. However, so we talked about before how sometimes people, they'll be like, I agree, I understand it, but they just can't help themselves, right?
And there are cases.
Of
course, with any rule that we're going to come up with.
Number one rule of the rules is knowing when to break the rules.
Right, exactly. Buffett has said that the best investments that he's made is when the numbers say almost not to make them. And then people have heard that. I think the part that gets overlooked with that, right, though, is Buffett has usually sticks so much to not overpaying for something that if he can convince himself, I'm probably overpaying, but I want to do it, then that's why it's such a good deal. Like that so if he's basically going to seemingly break a rule, then there's a really good reason for it. And so that may be the case with any of these things. If there's one time that you want to break that rule and you believe in strongly, it may be a sign that you understand something about that situation that's, unique about it. It could be. And
the second half of that quote was because you love the business so much.
Right. Well, that would be
Buffett's quote.
It's obviously the only reason why you would do that. Yeah.
All right. So back to the email. He said, however, I've been sucked into a sin stock B2B online casino provider, Evolution. He gives the ticker, which has one of the highest margins in all of the businesses listed worldwide, and its revenue is growing rapidly. I've been playing their live casino games, and I'm fairly confident that their product is the best on the market and most liked overall among players, which means online gambling providers choose them over their competition more often than not, including opening U.S. markets. What are your thoughts about these kinds of high price to sales stocks in general? Are you willing to make exceptions for the 10 times price to sales rule if the stock seems promising?
I'm trying to think of a case where I would ever buy something at more than 10 times sales, We can look at this one, right?
Yeah, this is through over-the-counter markets, but...
Okay, so some of the numbers may be weirdly skewed and stuff, currency and other things about...
What's their currency? Swedish kroner?
Is that where the company is
Stockholm,
listed?
I believe.
Yeah, okay. Then
Something like that.
That's what it is.
Yeah.
I'm assuming that's what the company reports in, but we don't actually know that, right? Does it? Yeah, and this just because everything in U.S. dollars, because this is the listed one over the counter. Yeah. So yeah, revenue growth is very high, and operating margins are terrific. In fact, some of the best we've ever seen. To compare, like we've talked about over the counter markets, I don't know, people probably know Facebook, things like that. That's what the margins of this company were a couple of years ago before COVID, right? If I'm reading this right.
Yep.
They were 40, 35, 40%.
High 30, low 40s. Yep.
Now they've expanded to being 50, 60%, before taxes and stuff. So obviously some of the best margins that you'll ever find. So that would justify a very high price to sales, right? So very, very high margins would be a justification possible for that. So, in theory, if you thought something was always going to have a 60% operating margin, then a price to sales of 10 for that company isn't different from a price to sales of 1 for a company with a 6% operating margin, which is more like maybe Walmart in its best day of the last, 15 years or something. So this would, that's the first point that would justify it. And it has had very high operating margins for a very long time. Now, there's a combination here that's very concerning. It's not impossible. I mentioned Facebook and it happened at Facebook. But, economic theory would say if you have very big margins and very high revenue growth, the durability of your business is in serious doubt because you should have everyone in the world trying to compete with you. The only possible justification is somehow you sunk a lot of money in up front or something else that's causing some gap between you and others that can't be closed after the fact. But usually, very high margins compared with very fast revenue growth does attract really tough competition. And that's kind of always my concern with Magic Formula stuff is that it turns up a lot of companies that might look good on Magic Formula, but it's going to fall apart. It's the reverse of a wide moat thing. It's something that's attracting a lot of competition, doesn't have a means to defend itself from it. We don't know qualitatively here. The email basically said that they have the best offering, which would probably be true if they have the results that we're seeing here. But it probably also means that everyone's trying to come out with a better offering.
So do you think it's tough when it's internet related things like this, because you could take a lot of capital and a bunch of engineers and build something? I don't want to call it on a whim, but we're not talking about like a lime quarry here or a casino that has some sort of regional moat to it.
Sure, right. That's the only reason why the revenue growth is so high, right? That I tend to prefer situations in which your revenue growth is a lot slower. Operating margin is big like this, although usually not as big as this, because you can figure out why it's defensible. Basically, it's defensible because although there's huge profits there, it's hard for someone to take you on at, say, that location or something, because you're already there. And why would someone compete with you, driving down both your returns? Why would they get permission to do it? All those sorts of things. So when we talk about like a Copart or something, they combine an online marketplace sort of thing, but they combine it with some offline stuff, which is how they start in the beginning, which is really has a lot of advantages in terms of local advantages and stuff.
So really it's a competition thing. It's an industry thing for you.
Yeah. But look, Facebook Google and YouTube, Facebook, eBay, there's a bunch of different things that from very early on were successful, had a moat and continued to grow for a long time. And it was very difficult for anyone else to catch up to them. So it's not unheard of.
And to be clear, I mean, you would like to buy something at a few times price to sales, and you just experience such high revenue growth and operating margin growth that the market puts a higher multiple on it. It's just if you were looking at it with a fresh set of eyes, you would probably never buy a company for 10 times sales.
Yeah. So
I mean, because you're saying, oh, you would want less revenue growth. A lot of people may be listening. Why would you want less revenue growth? Really, you're just saying that revenue growth is sort of the after effect of the business and the industry that it operates in, which could attract different sorts of competition.
Yeah. I mean, the problem is if you have very high revenue growth is that you presumably have lots of new customers. Lots of new customers are very dangerous because they tend to be easy to take, a new business to take. And so it allows others to get established competing with you. The problem that you have, this is similar with the margin thing, right? So let's say you have 60% margins or something. Presumably, if you had a ton of competition, you might have 6% margins. We don't know. It could be really bad. So you can only have these margins and these growth rates if you're succeeding really well against the competition, in the sense that it's very hard for the competition to take any business away from you. And then I just don't know the details about this. It would be hard to evaluate. But there are examples of companies that grew really fast. Usually it would be you have some sort of moat or something, and then the industry that you serve is just growing that fast. And so, operating systems, Microsoft, whatever, right? It just ends up growing so fast, your end market there, that you don't have to do a lot. And you're basically holding a lot of your market share, and that's all that's happening. The market is growing that fast. So, that kind of thing, I suppose, could happen. I can't think of a lot of cases where it could happen. It might be happening here. I don't know. I don't know what it is about their offering that it can't be replicated by others.
Well, how many people can replicate it? Could this be a regulatory thing? Online gambling?
No, it doesn't sound like it from this description.
Interesting.
I mean, there are some things we could think of that would be. So a lot of these things, why would your margins be so big and stuff like that? So margins can be competed away in a few different ways. In some industries, you're not going to have very wide margins because you have things with suppliers and customers that are going to cause the problem. But there are other industries in which, because of the product that you're making, you actually would be able to have incredibly high operating margins if you didn't compete with anyone. So it's really just rivalry that's driving it down. That's what I meant with like operating systems. Operating systems is a good example that way. you could have incredibly big operating margins, because the truth is that it's not a very big expense and it's critically important for the people using it. It's a tiny expense as a percentage of what they're doing. So that could happen in cases in which, say, someone is using the games that you make here, for instance. Let's imagine this company, you have a business subscription for it, but let's imagine that they're online sites that are doing this, and they're using they're the actual ones that run the games that are that this company creates. Let's see. Do they actually operate things themselves, or do they sell to someone else, license it to someone else who does it? Based on the revenue numbers and stuff, I think that they're supplying them, right? So they're the equivalent, the online equivalent of, say, like your slot machine maker for relationship to a casino. That sounds more like what I'm reading here, right?
So this portfolio of online live games primarily includes live roulette, blackjack, baccarat. Company is formerly
the revenue
operates approximately 8,000 tables. It says develops, produces, markets, and licenses live casino and slot solutions to gaming operators primarily. Yes, in Europe and the United States.
So I think that's how we have to think about it, is that it's similar to, say, someone who, let's say, made slot machines versus the casino that was using those slot machines to actually bring in gambling revenue, right?
Mm-hmm.
That's the difference. Mm-hmm. You know, that's the way of thinking about it. So what I'm saying is that makes a ton of sense, that you could have huge margins in terms of your relationship with your customer. You still always run into the problem, though, that you might not have huge margins simply because there could be a rival that you have that could take business from you, right? Because this company, if these are right, and it's hard to know this because we're looking at over-the-counter things in dollar terms and stuff like that. It's not a lot of revenue. It's actually only $1 billion or something that it's saying for 2021. And so a couple years ago, which is when presumably someone would have to start thinking about competing with you to have a big result now that we're seeing, it's half that or less, right? Like before COVID. So, there's a lag that way. But still, it's big. They're making almost $200 million a year before COVID, right? In terms of operating profit. Mm-hmm. So it should attract a lot of competition now that you're making almost $1 billion, or will very soon be making $1 billion probably. Then obviously it should bring in lots of competition. But it's still a tiny sliver compared to how much profit there could be for others in this industry, your customers. Mm-hmm. So if your customers have a much bigger profit pool than you do, then they could pay a lot of money for it. It's just the competition that you have with others here that would be the concern. And that's usually the concern. If you have, everyone always says that with high price to sales, the thing you would need to justify high price to sales, right, is high operating margin and high revenue growth. But that combination is the very combination that's kind of a problem for the idea of a moat. For, when people say that that capitalism kind of competes away these sorts of opportunities, the ones that it tends to compete away are high revenue growth, high operating margin combinations into a large total addressable market. So if the market's pretty small, then you can get away with that sometimes if it's very niche. But if it's big enough to attract others to do something about it, then you're going to face a lot of competition. But sometimes you might face a lot of competition, but that doesn't mean that anyone is going to actually take business from you over time. And we've seen examples of that. And that can be because there are other factors other than price that are most important to them. If the factor is just price, then someone's going to come in and be able to do that because you couldn't have operating margins this big. Huge margins are not going to survive in an industry in which there's serious price competition. If what people were looking for in general was low prices for something, then you're never going to be able to survive with these really big margins. But if there's other things they're looking for, which they might be, these operators, they may be, price might be a very small concern to them versus all sorts of other things that we don't know about because we haven't studied this company.
So what are some things that you would want to learn more about then to get comfortable with it?
I'm not going to buy a company that's trading at 15 times sales and that has
and we know that. So
it's not.
You
just
are not
the,
willing
it's
to
not
make
just
exceptions.
It's not just the high price to sales. It's also the operating margins we're seeing and the revenue growth that we're seeing. I would have I could talk to the company, the most important thing would be talking to their customers, but have an understanding of it to understand if there's you have to have incredibly captive customers for this to work. Like a willingness not to switch at all. You have to have the sort of thing that you would have if you were studying things like, eBay, YouTube, Google, Facebook, those things where you're like, okay, people keep using this even if they don't. They'll keep using it even if they don't particularly like it. They'll keep using it even because there's something about it that's locked them in. That may be that's because it's connecting buyers and sellers, and so that's where everything is that they need to find. It could be that they've learned how to use that thing. It could be support of something that they need. There could be a lot of different reasons. But you would definitely. It's an expected value thing. So if you want to make this bet, that's fine. The payoff could be very big. However, the outcomes could be more unusual than you might think, which is that it may be less likely that this just slows down and has anywhere near these margins. Like when you're doing the math on this, you might think, okay, so margins are 60% now. Well, maybe they'll end up, let's say, to be conservative, I'll assume they're 30% in the future. And I'm thinking they're growing at 60% a year or whatever right now. Let's say I think they're going to start growing at 10% a year or something. Do the numbers still work for me? And they might, but that's probably an incredibly unlikely scenario. The more likely scenarios are actually that the margins continue to be very high and growth continues to be huge, or like growth goes negative and margins collapse.
And if you're wrong on that, you're never going to be able to sell, obviously, at a 15 times price of sales.
Having said all that, even if the probability is very high that you lose a lot of money in the stock, the truth is that if you just bought it, put it in a drawer and forgot you owned it, it could make a lot of sense to own it. It could. If it goes to zero, it goes to zero. If it doesn't, you end up with a lot of money in some future period from just forgetting that you owned it.
Interesting. So more on that.
But definitely on average, like we were talking about arbitrage things, like what's the chance that they will work out? They have a pretty high chance of working out. If you fill your portfolio with things like this, 9 out of 10 of these are eventually going to go really badly. But I'm just saying that the one could pay for a lot of mistakes. So.
Yeah, the other ones that don't just become so tiny, and the one that does work out becomes spreading the bet. And also sort of the power laws of it all. Yeah, and companies like this also have this interesting feature as stocks that they tend to have, even though in 10 years from now it might be worth, it might be far beyond a 10 bag or something. It's not unusual to have drawdowns of like 90% in stocks like this in terms of your top to bottom in the stock of how far the stock price will fall, even though it'll be a success. People can see that even by looking at ones that are not as extreme as that. But I'm trying to think of famous companies that come anywhere close to this example. Maybe people can think of like a Netflix or something in terms of something that's online. I was growing very big, whatever. And they know it's been a huge success now and grew from something very small, has been public all that time. Still, they're probably it's bigger drops than people are used to. Yeah, it's like Amazon, right? When you look on a chart, an all-time chart, those little blips look like nothing. But in the moment, those 50, 60, 70, 80% drops are very real.
Right. What's interesting about this, though, is that this company has no danger of financial risks and stuff like that. Like we were just talking about Tesla, which is what, $1 trillion company or something? What is it?
Yeah.
Okay. Or was it trillion? I don't know what it is now, but
but around there.
But okay. But what's weird about that is a couple years ago, it was, I think Elon Musk would say, there was a serious question of whether it would survive financially.
Yeah, he's talked about it, and
we're not talking about too many years ago too.
It was a couple of years ago that he tweeted Tesla's price was too high.
Right. So, but what's interesting about that is, and so we're talking here about a company that has none of those risks. It'll never be as big, but that it never didn't have that issue. Some of the things we're talking about, Amazon, Netflix, Tesla, they all had serious credit moments of serious creditors were at risk. Creditors are at risk of not getting paid 100 cents on the dollar. So equity was at risk of being wiped out. And that we're talking about something where that's not the case at all. So when you're
Look
making
at that
much
growth
money.
in shareholders' equity. Even since 2018, 2019.
Yeah, so they've retained about $1 billion, if this is right. Paid in capital. I don't know what that means exactly, because why would they issue a bunch of stock? Those numbers could be, because it's over the counter. We're translating it from not translating it literally, but we're taking it and moving it over from filing from another country. So I don't know if that really makes sense, because it doesn't say that they issued a bunch of stock.
Yeah, right.
Yeah, we would need to look at their real filings.
You can even look at the shares outstanding. It's gone up. And then you look at, so what is that, issuing shares? Yeah, that's odd, huh? Why would they need to issue stock?
I don't know. But I mean, it doesn't really matter anyway, because the retained earnings is huge from what we can see. Although it's only a short period of time. But no matter what, we do going back looking at this, it just was making a lot of money for many years and more money than it needed each year, which is very different than some of the other companies we talked about where there was serious risk that way. So it's a hard one to evaluate. I don't know. It clearly checks all the boxes of something that looks attractive, but the risk is, it's entirely qualitative that I don't understand. How would you get comfortable understanding if there is a moat of some kind there and then doing the math on it? All I would say, is that when you have very high revenue growth and very high operating profit, so like next year, presumably they would make over $1 billion based on this, right? And if you've been growing, so then people are looking at that saying, okay, if you could get a position like theirs, you'd be making $1 billion, you'd be making, $2 billion in a couple years, literally a few years. That usually attracts a ton of competition. So it's just that there'd be a ton of competition, but presumably there is a huge amount of competition in this area. Mm-hmm. I can't imagine that there isn't. Not a small company though. How many employees did say that? Like, it was just on the when you were on the search engine or whatever.
9,805. Yeah. Well. Wow. The topic of today's discussion, why I looped these all together, was because a lot of people were interested to hear your thoughts on spotting profitable growth versus unprofitable or bad growth and what to look for anyways. So maybe we could define growth to you, because I think your definition of growth is a little different from other investors. What is sufficient growth for you to be interested in the company?
It depends on the company. I mean, if there's some companies where if they didn't even grow their real business at all, as long as they raise prices over time, I wouldn't have a problem with buying them. So
somebody tweeted the other day, why is it so hard for us to buy profitable growth companies? So basically, he's very attracted to these unprofitable growth companies. Is it because of the revenue growth in the future? Is it because they were rewarded for doing that recently? Because to me, I feel like it's hard to buy unprofitable companies, but maybe that's just because I come from the hard knocks of Gannon University.
Well,
I don't know.
I don't want to be, this is going to sound very, I don't know exactly condescending or whatever, but obviously it's much easier to grow unprofitably than profitably, because you can take customers from someone on a competitive basis that makes no sense, right? So like people can say Carvana got this many more customers. Okay. I mean, if you gave us enough capital, we could take customers from Progressive and Geico as long as the regulators let us write the business. So that's part of it. I mean, Carvana is a really interesting example, because if you look on a certain basis, there's a way of looking at where you say, okay, this business model makes sense. Because people asked me about this years ago about Carvana, and you say, okay, this business model makes sense. It sort of makes sense if they can somehow get the customers at the same rate and continually refilling the need for those customers over time. So if it was sort of a recurring business, right? And on the gross basis, it's making sense what's happening here, right? If that's correct. So like we can see gross numbers in here, and you're saying, okay, 15% gross margin, 14% the year before, 30%, 10%. Okay, those are numbers that make sense as a car dealer. However, as you can see, the operating margins are really significantly negative. right?
Yeah.
And then it gets more complicated than that because also do with capital things and stuff like that that we're not getting into, but the cash flow stuff is even worse. So there's always an argument of whether it makes sense, whether the business can be run at all on that basis, or that you can actually get to a steady state where you're making money. And I've never been sure if that's the case for Carvana. I think there's some question that it's not because they got to -1, it's gotten worse since then, but -1% basically operating margin in a year that was the most profitable year in the history of, car dealers. Yeah. Mm-hmm. Which won't be repeated.
Like if anything is peak, it's this.
Yeah. It's hard to explain how a lot of car dealers made more money while basically more money, I'm saying like double, triple the earnings, while basically not being able to actually sell any more cars, any more actual units and stuff, a lot of them.
And that's because of the prices.
That the prices went up a lot, yeah, because of a serious supply and demand issue. Yep. Yes, correct. Yeah.
So, I mean, we're looking at this company and they're not even profitable.
Carvana is an extreme case. It's known, as we're talking about this, is known to be in severe financial straits. I think I don't know as when I'm recording this, what's been decided and what hasn't and stuff, but I think they need some support in terms of getting some debt financing in place and stuff.
Yeah, look at because cash flow from operations.
Yeah, can you see on a quarterly basis? Yeah, so their cash burn was... let's see. So they've had the best quarter they had recently was a $300 million burn without the PP&E. And they're trying to do a very large acquisition too. And the acquisition is actually a company we've talked about in the past. Do you remember Car Auto Auctions? Maybe not.
No, I don't.
Okay, so they have a business at Odessa, and they're buying as something that's associated with that. Basically, it's part of it. But that sort of adds to it because I think their reasons for doing that might be to secure it's logistical stuff, like to secure supply and stuff like that, which might be an actual issue for them. So anyway, you can see net issuance of debt and all of those sort of things. It's the kind of thing that wouldn't exist, right? Carvana wouldn't exist if it wasn't for a different interest rate environment, and that interest rate environment is happening now. So, Uber, that's why they're saying that. It's not like the CEO suddenly decided, we got to think about free cash flow.
Focus on free cash flow.
It's that if Uber tried to be created today, it never could. It's just that it had that runway of a decade or whatever where interest rates were nothing.
Gosh. They just burned so much capital.
Yeah. Uber, at least, I guess who knows, maybe Carvana too, but Uber at least has a sort of story that, in theory makes sense. I don't know if it makes as much sense.
What do you mean?
Well, Carvana's a little harder because at the end of the day, you end up with a model that looks a lot like other car dealers.
Like a car dealer? Yeah.
Right. This is the Tesla issue, their business model can be a bit better than other car makers, but as far as a stock, it's a bit of a problem because it still looks a lot like a manufacturing business. You know what I mean? It looks like Tesla, in fact, looks like a manufacturing and dealing business. And its numbers aren't that far off from that, which is fine. As a business, it's fine for them making a profit and everything. But it's the valuation that you have on top of it. Uber's valued at what, as much more than Twitter?
Mm-hmm.
Twitter's been making money for a while,
Yeah.
And just has a business model that's very obvious what it is, that if they got to a certain scale, would be making a lot of money. There's no doubt that a media company like a Twitter, advertiser-supported media, makes huge amounts of money once it gets to a scale that's successful.
It's just interesting. People are like, it's a tech company. But then you look at the numbers and you're like, well, it doesn't burn or generate revenue like a tech company. It burns cash flow. Excuse me. It burns cash flow like a early stage railroad.
There's a mix of companies. They're all companies that are future oriented, right? It's that we're not going to make money today, but we need to burn money today. So we need your capital up front for the future, right? So that's what we've seen a lot this decade. So you get different kinds of companies with that. And some of them may work out really well, but the connection to it being tech or not, the connection is really what we just talked about, the burning the money up front to get to a certain scale to make money in much later years. Uber and Carvana and those sorts of things are very different businesses from, like, Twitter's a really good example of something that didn't really work out how people hoped, but checks all the boxes of it looks like it should be incredibly successful because it matches all these other things of other companies that were really successful. And from previous generations of companies, it has a model, advertiser supported media stuff, that's also really successful. So it's basically, if Facebook and Google are really successful, if old media things are really successful, then why can't Twitter be successful? These other ones that we're talking about are tricky because you're having to convince people, not just you're going to disrupt, car dealerships, not just that you're going to disrupt taxis, but that somehow the business model is also going to be different in terms of the profitability of it. Right.
What's so interesting? You look at Block, formerly known as Square, and you look at the revenue growth since 2012, gone from 65 million to 4.4 billion.
Mm-hmm.
And you look at the net income, the profits that the business generated. It's gone from negative 85 million to 166 million. And you look at the shares outstanding, it's going from 277 million to 502 million. There's a lot of similarities between this company and looking at this income statement and Twitter.
Yeah.
And what's the common denominator there?
Well,
the person running it.
The person running it. But I mean,
look at, again, you go from 65 million to 4.4 billion and you're barely earning any net income.
But it's like a whole community around that person too. I think a lot of the companies that we're looking at here are all, although officially public, are basically understood to be, you're investing in the
vision, the WeWork type thing.
It's venture capital. It's just that it's public. This is a stage beyond that. So a lot of the attitude is the same in terms of, attitude towards things like share issuance and all of that kind of stuff. And it's totally justified in that I think that is what shareholders have wanted up to this point. Now, the turnover is high in these companies, so they may get an entire different group of shareholders in the future. But there's no doubt that what they want is very high revenue growth. Don't care if you're losing money now, as long as you're going to be the leader in the future and make us a lot of profits eventually.
They're basically right back to their pre-COVID ramp.
The issue, though, is that for most of the companies that we're talking about is like the great successes, which I keep trying to bring up. Like, okay, so what's similar to this? What could you have paid a high price to sales for? What, has continued to have really high margins or whatever from the previous generation of really successful companies that got really big. Those didn't lose money for nearly as long. Like, there really isn't, when we look at, we compare them to the Amazons and the Googles. And
could that be because of when they went public in their life cycle?
Oh, yeah. Oh, no.
And I'm saying like the sources of capital now that follows these companies is changed since the Amazon days.
Oh, no, I think it's just the timing. Yeah. Amazon would have been able to lose money for a very long time if it wasn't for the .com boom imploding. And Google would have been able to if it didn't go public when it did. I think that it changed their way of thinking about things dramatically. Although Bezos maybe would have thought differently anyway. I think there's some evidence that he always realized it wasn't going to go on forever. The capital markets part of it. That even though the internet was going to be a big thing, that that craze wasn't going to last for very long. So
he didn't seem as delusional as these other people that you hear about.
Yeah.
He's always known, it sounds like, that it was all about like free cash flow and stuff like that. I mean, he's written about it. Read his letters. DraftKings, another company. I mean, how do you decipher between good growth or bad growth, whether that's unprofitable or profitable?
These are ones that I have no idea, right? Because customer acquisition costs, what are they? And how long do you keep the customer and how loyal is the customer? That's the problem with all these things. It even is to some extent with something like Carvana. If they're doing stuff that I don't understand and is really a lot smarter than I realize because they're actually going to be getting customers for much longer time, repeat business and stuff than I realize, then I might be misjudging it and definitely not giving them enough credit that their long-term, that what I'm saying is like a annual expense is really a long-term investment, So there's lots of companies like this where that's what it comes down to, is the argument over whether they're going to sort of maintain the business and whether they can continue to bring in customers along. I mean, like I think we've talked about before, there's a stock. I don't love the stock or anything, but I've always been surprised at how heavily short it is and how it gets written up all the time. It's just 1-800-PET-MEDS. And it's a perfectly fine little business. The economics of it are really good. The economics of the product make a lot of sense, but there's definitely questions about like whether the marketing is that effective and everything.
PetMed Express, or is it
that it does business under the name 1-800-PET-MEDS, but yeah, it's called PetMed Express. And it just hasn't been that dramatic. It's slow to not growing that much, but there's always been people talking about shorting it and stuff. And the business maybe has gotten somewhat worse over time, but it's been pretty much a reliable company capable of paying dividends and stuff. And it's continued to pay dividends even now, I guess. But there have been arguments from early on about it that are sort of along the lines of what we've been talking about here, which is judging like customer acquisition costs and things like that. They kind of slowed down to just give up being a growth stock, and it worked out okay enough for them and then paid out dividends. But if they had pursued the same exact strategy they were in the early days, I think it became more and more costly if they wanted to try to continue to be a growth company, and it wasn't going to happen. And maybe some other companies do that where they just continue growing rapidly. All the ones that we see with these unprofitable tech things, and not just tech, but other things too. Some of the problem is that they think that they're going to grow very fast, and so then they increase, like we saw, inventories. They increase their spending on all sorts of things and overhead, and then you run into problems that way. Mm-hmm. And some of those are different.
Let's talk about a company that we have used as a growth year type of company on the podcast before, because you did ask for ones that you would like to see. And this is a situation where they are able to grow.
Yeah, well, the recent growth is totally unusual. They're not a very fast growing company normally.
No.
OTC markets, yeah.
And pay out dividends, mm-hmm. and they don't need to retain as much capital. Either they don't need sources of external capital to grow their business.
Mm-hmm.
So any thoughts on over-the-counter markets as a profitable growth company?
Yeah, if they grow even faster, I'd like it more.
So there you go. So why is that? Because
I understand.
Would you like this company at 10 times sales?
If it's growing at 50% a year, maybe.
Okay.
But it's not. But I mean, other companies tried to compete with them, and I mean, other much more capable companies. That is, they had much greater financial. Yeah, other exchanges, ones you've heard of, had tried to compete with them and gave up on it and stuff. Yeah, and I think it's pretty powerful when you have. I mean, we even talked about that. And I think it was misunderstood in some ways that I was saying like Netflix will survive. Of all the FANG things we talk about, like Netflix will survive forever.
Oh yeah, you're the one that you would buy?
The one that I would buy, yeah. Whether it's a good business or not, it will live forever because all the content is on it and all the people are watching it, and it may change completely what content is on it and all of that. But like, I mean, CBS, we're talking about with Paramount. CBS is like one of the very earliest. It goes back to radio, but one of the very earliest TV things in U.S. history. It's still around to this day and still has some of the highest ratings.
Has it always been surprising to you that over-the-counter has not traded at like a 20 times free cash flow or a higher multiple, 25 times? You look at these other more followed growth companies that trade at those valuations.
Oh.
It's always been surprising to me. Over-the-counter markets has always seemed like it would be an interesting buy point. A cheap buy point. Maybe not cheap, but fair.
Well, yeah. I mean, it is, how much the non-professional user stuff was down, right?
Yes.
Like 50%,
tremendously.
50%, yeah.
Yeah, but I don't even think like we've gotten any multiple expansion since we've purchased this company.
No. Well, you don't have to name them now, but when have we got multiple expansion or anything since we started in the last couple of years? It's basically nothing. We've had stocks that go up, but not faster than their earnings, really.
CSVI.
Okay, there you go. But yeah, in general, even if we've had gains in stocks, their earnings have gone up even faster than their prices.
Which is something that obviously we love to see. That is something that you should see. That is something that you should love to see as an investor. Yeah,
I wasn't expecting a 46% increase in revenue at over-the-counter markets. Right. So now earnings per share did well. And we kind of were expecting that because we knew that they had kind of, a couple years ago, about 2 years ago, had kind of started to spend big on some things that hurt their earnings results that we didn't think were, that they were sort of one time or investments in the future, whatever, like you don't need new expanded office space every year or something, people ask about that kind of thing. How can you tell when the results might get better? Sometimes we can tell that like margins should get better, and we thought margins would get better.
I mean, that was literally in the filings.
But we definitely didn't think that there'd be this huge speculative bubble of just, even if we thought there was going to be, we definitely didn't think that it was going to be a lot of individuals trading over-the-counter type stocks, things like that. We didn't think it was going to be that kind of thing. Literally, penny stocks and highly speculative, U.S., not these ADRs and stuff that they make a lot of the volume in normally, but stuff that's, I mean, we definitely didn't think that there's no reason to think that would happen with over-the-counter stuff. Just because people like the FANG stocks and Tesla and stuff, that doesn't affect these kinds of things normally.
But to show
that was a completely unprecedented. Yeah.
Yeah. And to show him like a growth company that you like. And again, this growth isn't,
very slow.
Yeah. 12%, but a lot of that's probably skewed by an unnormalized 2020.
But how much of it is not pricing, right? How much is the actual growth is incredibly low at this company.
But look at, like last couple of years, 18 million in profits, 30 million in profits. Then you go over to their balance sheet, right? You could see, their shareholders' equity, it's not a lot relative to the market cap. You go to the cash flow statement, look how much cash they're generating. And the amount they're paying out in dividends, they're not retaining a lot of capital in this business, is what I'm saying.
No, they're probably retaining too much. But they're definitely retaining too much. But that's a sign of a good business that way.
The sign of a growth business you like.
Well, because it's the only ones that I feel capable of being able to judge.
Which, to be fair, I think if we looked back at evolution, well, maybe I guess they did issue stock and stuff like that. So I don't know.
They also
and they were
always
retaining a lot.
Except for this past year, over-the-counter markets never grew at anything like these rates. This was never a very fast-growing stock. I think
it was a 6 to 8% top line growth, something like that.
I'd say the 10 years prior to this were. Yeah. Maybe it depends. It probably averaged. Well, it depends. I thought they were going to do okay, even if COVID hadn't happened. I don't think 2020 is the real issue. Is 2021 is the unusual part. The 2020 part is kind of normal. I think they could have done 10% growth over the last 10 years or something like that. I think that's possible, 9% or something like that. I don't think 12 to 13%, which is what we saw there. And then, of course, we had earnings per share growth even higher than that. So now for the decade, it looks like they grew 12 to 13% a year, but that's because they had a 46% growth in 2021, which will obviously change a lot. And that's why, while the price might not look that expensive to you right now, it's because people are concerned that it'll drop, that next year will be worse than this year.
But it has never looked too expensive to me.
Right. But
it's never been a situation where I think Munger has spoken about he wouldn't buy Costco today, but he's just not going to sell it. I feel like for over-the-counter markets, since we've been involved, it's always been I could see this being a fair price to pay.
Right. But the thing with over-the-counter markets and with growth stocks that I look at, if you can even call them growth stocks, is so the growth in earnings per share looks good, right? Yeah. So they have like 19% growth in earnings per share over the last 10 years. That looks good. That looks like a growth stock, right? Actually, that outdoes some of the stocks we mentioned, probably. I don't know that Google's done better than that. But it's achieved with very, very low growth in year by year, normally. A lot of that is through profits growing faster than sales, so margins widening out. And then also it's achieved with actually pretty slow growth in things like number of users and number of listed companies and all those sorts of things. And then price growth on top of that. So you have like inflation level price growth on top of that. If you think about it, how much has it really grown faster than like an economy? How much faster than financial markets in general and stuff? Not really a lot faster. A little bit faster, certainly this last year faster, but in general, not. And so that's the kind of thing that we can look at, that they're going to make a little bit more money over time. The things that we like to see are like, the Geico growth, right? So Geico's been a growth stock for 70 years or whatever. But it would never be one of the fastest growers. It's just that it never stops growing.
Mm-hmm. And then they have their capital allocation down, payout and dividends. Really, they buy back stock to offset dilution.
Right, but there's no question that evolution is a better
growth.
Has higher growth and it's better business as it exists today. The question is just whether it has as wide a moat. And some people may say it has a wider moat because some people are worried that, over-the-counter markets, that there's some threats to it. There's regulatory risks and there's risks from other companies going at them to doing things that harm their business. Of course, there's always headline risks. I just think it's my feeling about it. It's a very small pool of profit for a lot of headaches to try to establish yourself to be at the level that they're at now. Mm-hmm. Right?
I want to look at Beyond Meat really quick.
Okay.
Because this was just
covering a lot of things I don't know anything about.
That's the beautiful part about the podcast, Geoff. Look at this.
Yeah.
We got the income statement. Does this business model work if your revenues are $109 million and your cost of goods sold is $109 million?
Well, this feels like when I was looking at, ethanol companies back in the
When I looked at this, I thought there was a typo. I mean, I'm saying like I had to do like a second glance. I was like, whoa.
So what happened? It was a huge increase in costs.
Yeah.
Because they use plants or something? What is it?
I don't know. I mean, not food, right? Not meat.
Yeah, I mean, obviously there's a lot of companies where this will be a issue, that you have these cost increases, right? And then no sales increase. Well, actually, if you look, right? So this most recent figures, if we look at them, it's not as bad or something, but it's kind of the issue that like Walmart had. As we were recording this, Walmart had not amazing earnings. And the issue was a tiny, tiny increase in revenue and then inflation driven increase in cost of goods sold. And that's what we're seeing here.
Has this company ever though generated cash ever from operations?
No, but people don't want them, their investors don't want them to, presumably.
I just think it's a very hard game to play like that. But maybe they think the game that we play is hard and stupid. I don't know.
Well, I mean, you have a new idea, right?
What do you mean?
Well, they want to do new and different things here. They have to
new.
Create markets for these things.
Sure. Mm-hmm.
I mean, that's true whether we're talking about Amazon back then. I don't think the internet, I don't think railroads would have gone as far as they did, or the internet got as far as it did, if it hadn't been to had some amount of overly excited capital going into it, capital that was overly optimistic about some things. And that's true for green energy stuff. It's true for a lot of these things, to some extent. When you're looking at Tesla or something, you have to kind of put out of your mind that, well, if everyone's going to make electric cars in the future, then isn't lithium going to cost a lot? We'll get to that when we, hopefully we'll have a scale and everything that we can deal with each of those bottlenecks when it happens, and then, so that your cost of goods sold goes up and all that, because you have cost pressures coming from it. But you just make it work on a small scale, and then you go, okay, now let's double that this year and double that and double that. And, eventually it'll work out. Mm-hmm. But because you're creating a market that there wasn't one there before, and that's what they're doing.
Well, I just wanted to demo out a profitable growth company that is one that Geoff likes.
Yeah, I don't have a history of liking a lot of growth stocks. People should know that. I mean, in terms of...
What is the definition of a growth stock? I think of it like 20% a year.
Okay, well, I don't... Look, OTC markets, 19% a year, EPS 10 years. So not even a growth stock. Right?
Yeah. By my definition.
Mm-hmm. And in terms of your 20% a year thing, 1 year in the last 10 did it even increase revenue by that. In 6 of the last 10 years, 6 of the last 10 years was less than 10% growth, right? 3 was 10 to 20%. 1 was incredibly high. All right. Can we see the 20-year numbers?
Sure.
But I think what you're going to find here, this is similar to like a financial company and some other things like that. It is more predictable in that it has far fewer years of very high growth than you might expect. Now, on like a rolling 3-year basis or something, though, its growth is consistently very high. And that's actually one of the things I do when I have like an Excel thing. You've probably seen me do that. I don't know if you've seen me use Excel, but is to use like a rolling basis to show people, like, for instance, that sometimes a company that they think, like if I say it tends to earn more than 10% return on equity, if someone looks and they go, oh, but this year was 7, this year was 4. But if you take a 3-year average and it's always higher than 10%, then to me, that's the pattern that over time is what you have to worry about. The fact that you have occasional cyclicality isn't a big deal. So can we look at ratios?
Sure.
Okay. Let's go to the revenue growth line. Can we find that?
Let's zoom up here.
Year-over-year growth, yeah. So how many years do we go back? Not that far with this company, right?
To 2010.
Okay, so basically the same that we just saw.
Yeah.
But what you see there is a few things. One, it's always positive, right? What's the lowest growth year?
It looks like 1.4%.
Yeah. It's not really...
Absent 2021, growth hasn't been crazy in revenue. I mean, sure, you had an 18% year here, whatever happened in 2014. But...
what I can do is new markets, new products. How do I predict the growth of those things?
And maybe that's what it means when it's growth. You think growth, it's, we would love high growth in a company like over-the-counter markets because we think the moat is so great.
Right, but if someone...
can't say that about every single company.
Right, so like if someone said to me, we don't own this stock and I've never owned it or anything, but say like Sprouts, okay? So if you go to a company like that, that's the kind of thing where I could... Sprouts Farmers Market. So if you go back in their history, they weren't in a lot of markets, and they could go into them, and they had a business model. So you could say that, or you could say a restaurant concept, right? I could take that. So some of the things that Peter Lynch wrote about that he felt he was successful in, motels and restaurants and things like that. I wish that they were still as cheap as that. If you go to QuickFS and type in Dutch Brothers, just Dutch, and then you can get the rest of it. It'll be Dutch Bros or something like that to show you one of the issues here. So here, there's hope that this will be like, it's a drive-through. I think it's drive-through only, literally, but it may not be entirely drive-through only. But it's basically like a Starbucks type idea. But it's, you drive through and stuff is the big thing. So it's coffee shop kind of thing, okay? That's the best way to summarize it. But you see the problem. Let's say, and I'm not saying I do, love this concept. I said, okay, this is amazing. I went there and it's great. And I think that this is a great future. And I wanted to look at it on that kind of basis that it can replicate this in market after market. I'm just giving an example because like coffee works everywhere. So they could take this to every state. If I found the first one of these, right?
Total addressable market is infinite.
So what does it say the market cap is on this thing?
5.2 billion.
Okay, now here's where I'm going to... Are you familiar with the company at all?
Absolutely no.
Okay, so what you have to do now is type that into OTC Markets, BROS. So you see it's like 8 times sales and it's not making a profit and all that kind of stuff, right? So what you're going to see now, if you look to like 5-year, 1 year. It's only been public for a short time, so... do you have one like that? 2 year, 5? Yeah. So what you'll see is it's actually down already, I don't know, 50% or something in the last, so this company had a market cap of, I don't know, it was probably, we can go to QuickFS to see this. So type in like Cinemark, for instance, CNK. Right. So, yeah. So this thing is down 50%. And is bigger than like the enterprise value and stuff of Cinemark after being down 50%, right? So just an idea of like that's one of the top 3 movie theater companies. So the addressable market thing is, it's priced at such a high level so early on that how could I buy into that? We've talked about that. You mentioned a restaurant thing to me, a restaurant that you liked a lot, right? And it's fine, but when they go public and everything by that time, usually it's hard they're just not cheap enough. To be able to evaluate them at all that way. So if there were companies that were successful on a small scale with a concept, and then I could look at it and could see a future where it could be duplicated.
Yeah, it was Portillo's, and the stock's done nothing but just get smoked since going public.
Yeah. Without it baking in those future earnings. But, Peter Lynch was investing at a very different time, very high nominal, but very high interest rates and things like that. So very different attitude where people focused a lot more on the current PE. Now, they did focus on growth and all that, but they definitely were not saying, okay, in 1980, we'll wait and see how much you're going to earn in 1990. Mm-hmm. Where here we have the reverse situation, where you have companies that already have a lot of earnings and everything and maybe not get as much credit for it if they can't grow at all, versus companies that can grow a lot. Because like do Starbucks, for instance, it's doing fine on what its prices are, but its price to sales are a third of
Dutch Bros.
Dutch Brothers. Yeah.
Have you been there before? Dutch Brothers?
No.
So Texas.
I look locations. Well, there's one right in this town.
Oh, is that right?
There is, okay. Yeah. It's not here yet, though.
Now everyone's going to know where you live.
It hasn't opened yet.
It's the only location in Texas, and they're going to pinpoint you.
But we're talking about something that's, what is this, a third, right, of Dutch Brothers?
Yeah.
So I just mean it's very self-funding and stuff. It has been for a very long time, whereas we're looking at something that isn't and already has a much higher price to sales ratio. So that's just what makes it harder with evaluating any of these things. That's not the case, of course, with like the email that we got. Right, because
evolution,
because it is already generating tons of profits, has been for a long time, and all of that. So you don't have to deal with any of those issues. You just have to deal with a high price of sales. That's kind of unusual. Mm-hmm. So that's a very unusual company to look at that way.
Okay, but we could talk about Apple. Buffett investing in Apple, right?
Yeah,
10-year CAGR, 13%. Mm-hmm. They have experienced extreme growth recently.
Yeah.
So people could call us a growth company, but to Buffett, it's the moat of the business.
It's what you're looking at. It's got the same exact numbers as OTC markets last 10 years.
Perfect.
So
OTC maybe we could get
has higher operating
20
margins,
times
higher returns on equity and stuff like that. But
22 times free cash flow, start to get it up.
Yeah, but in terms of growth, they're the same growth rates. Yeah.
But even he's talked about the investment before. It was nothing to do with the growth of the business. It was everything to do with the ecosystem of the business and the moat of the business.
Well, and I think the capital allocation.
Yeah, and the capital allocation.
Yeah, because that's the issue, is that it becomes very important what the capital allocation is and the price and things like that if a company slows down its growth. Like, I don't want to say it's, because I'm sure from the CEO's perspective, from management's perspective on a lot of these things, the really difficult type of thing to manage is something with a lot of growth. But I have said a lot to value investors, you want like a slow growth stock or something.
But what's slow growth? GDP type growth?
Okay, that's fine. Yeah, GDP type growth, we could say. You want something that it sells more units each year. Something like that. Just because it makes it easier for the company. A lot easier. They can become very dangerous what they'll do if they're in a shrinking industry. And you have to be very careful and very focused on what management is doing and what their plans are. And very careful. I don't think people appreciate, that's definitely something that I don't think people get as much when I talk about like a NACO or something like that, is how critical that is in assessing to buy that stock was what they were going to do. My fear, everyone would talk to me about it sort of mathematically as like, well, your fear is like that coal over time goes to zero or something. Not really my fear. My fear is that when presented with a situation in which they see a slow decline to nothing in an industry, they rapidly, most companies, end up doing this. They feel threatened. They feel this existential threat. And they react in all sorts of value destructive ways potentially. Sometimes they get lucky and end up with something that turns out to be really successful. But they start doing very unpredictable and strange things, and it's the reaction to that is part of the problem. And that happens to tech companies sometimes. They go in totally different directions because things change so fast in their industry, So I do like to see something where they feel like they have something that they can do, and there's kind of a clear path to what they're going to do in the future. I like that. And even a lot of the like Phil Fisher type companies that he would own, in some sense, they had that where they would go. The organization was capable of doing research and moving gradually into trying out different products in certain categories. He sort of believed in like research-driven companies and things like that, which is different than a company like some of the tech companies we've talked about, like the modern era after Phil Fisher, like the Microsoft or something like that. They become wildly successful in one area, but the truth is it doesn't really help them figure out how they can then take that and put it into anything else. Like it didn't naturally give them an idea of what else they could do. Some of these companies do try other products and things, but a lot of it is like being lucky and making acquisition here or there. Not necessarily lucky. I mean, they may have known what they were doing, but taking a lot of the cash that they have or shares and buying other things and developing out of that.
Being able to pivot.
Yeah, I mean, operating systems and Xbox consoles don't really have a lot to do with each other, but they kind of moved into different things, a lot of different stuff. They didn't have a natural sort of evolution the way he would with a company like, Dow Chemical or something like that would be the kind of thing I would think of with him.
With Phil Fisher.
Yeah. Those are very organizationally driven things with a lot of research into different stuff. Some of the stuff Teledyne did in the early days is similar to that. So this book?
Yeah, I recently purchased it for my Kindle, but I have not started it. But we were talking about Apple, and I'm excited to read this book. After Steve, How Apple Became a $1 trillion company and Lost Its Soul.
Oh.
What does that mean? I don't know. Read it to find out.
Maybe it'll be a negative book.
Maybe.
I don't know. You can't. So a lot of times you can't tell from I've read a few books where the title was quite provocative and the book was not.
Interesting.
So it's almost as if they tell you what title is going to sell the best, and that's what you put on it.
I'll have to report back on my thoughts on the book.
Yeah, Buffett's had success with Apple, and it's been it's a very slow growth stock since he owned it. It had 1 year where it had really high growth, but it's had strong earnings per share type numbers, and then it's also had multiple expansion. And
they've also repurchased a lot of shares, capital allocation. So
they had definitely a lot of share repurchase, which is the kind of thing that he likes a lot. The same thing with American Express or something like that. Yeah, so those are the ones where we'd be able to, something along the lines of Apple in that the last 10 years, maybe we could predict. But I don't think 15 years ago we could, or I could, because you worry about how much it changes. You read Losing the Signal, right?
Yeah.
Yeah.
Yeah, that's a great book for people to read on how quickly things could change.
Yeah, I mean,
research in motion. I mean, what were they doing? Was it 20 billion or 2 billion? I think it was 20 billion, right? 20 billion in sales to basically like nothing very quickly.
Very quickly. They went to nothing. Yeah. They basically had all the smartphone sales there were because there were no smartphones. I mean,
yeah, it's not going to have anything.
Now it's called BlackBerry actually, and it doesn't really exist. I mean, it doesn't have anything left of what it was before, but it also renamed itself. Yeah. So, from back then.
Yeah. Let's see if QuickFS has it. But yeah, that's a great book for people to read just to see how quickly things can change. Yeah, 20 billion.
Yeah.
Look at that. Right on. Spot on.
But, for any of these things, it's the difficulty of when we talk about this, it always makes it sound like I'm saying like, don't buy tech things or whatever, which is not what I mean. All these industries eventually end up in the same place, right? Like cars were tech at one time. Gasoline powered cars were technology at one time. There were a couple thousand car companies. It went down to a handful of them. And then it didn't change a lot for a very long time. We're not going to see some huge changes probably in the things that we talk about with, Google and stuff like that. You had a lot of change early on. And so you can go back to there and say, well, at some point it became, the difficult thing is at some point it becomes predictable that Apple has a position that's really strong and that they're going to maintain. But at what point did they get past the BlackBerry position and into a different kind of position? At what point did Facebook get to a position that was different, looking forward in terms of probabilities than MySpace had been?
I mean, Apple's not really a one product company like I would call BlackBerry. Like, sure, they had multiple phones out at each time, but really it's a one product company. It was a one product company. I mean, we know that because the iPhone and other competition basically killed them.
That's true.
I mean, look at that. Going from 18.4 billion in sales to 11 billion in 1 year, then to 6.8 and then 3.3. And then, I mean, it's just been slow decline.
My favorite part of that book is when they tell them, like, they give an estimate of, like, in the next year, they were talking to some consultant things, and they're like, well, in the next few months, like, here's what percent of your customer base we think is going to leave. And what's interesting about it is, so they give them an estimate that in about 3 months, what it would take probably about a generation to lose as Coke or Pepsi. Like, in 3 months, you'll lose what it takes 30 years to change market share in those kinds of industries. So, but that doesn't mean that wasn't, when Coke first started, obviously they took a lot of market share fast. It just stays the same for a very long period after that. Mm-hmm. And so there are these moments where there's a huge shakeup, and then after that, we don't know. We talked about Paramount, right? So, like, movie studios, that happened, and then there was a period where it seemed there's been very little change for an incredible amount of time, but there was a couple of decades where there's a lot of change, and then there's been the better part of a century where there isn't. The same thing will happen with streaming probably. At some point, we're going to look back and say, here are the 5 or 6 or whatever, and these are what everyone uses, and not say, oh, there's going to keep being new streaming companies that are going to ever get to the size of Netflix and Disney Plus and, all those sorts of things.
Yeah.
But no one, rings a bell and tells you exactly when that time is, when it shifts from being an emerging industry to one that is now become predictable, and that we know a lot about what the structure will be for a long time. And then sometimes in some industries, there's a big upset at some other point in their history, and then it changes again.
Which is pretty cool to do, which I didn't do it for losing the signal. I should have, is when you're reading these books, go back on QuickFS and actually look at the financials to kind of interact more with what you're reading. I think that'd be fun.
Yeah. So, could we look at their margins and stuff like that? Could we look at the ratios?
Yeah.
Okay. So what happened here, which is strange about it, right, is that, so it's not just that people started competing with them and stuff, but kind of what happened is the market became an order of magnitude bigger. So no one would ever have the market share that BlackBerry had, actually. Like, Apple never achieved it. There was never a market share leader to the same extent as this. But what happened is almost instantly, the market became 10 times bigger than anyone dreamed it could be, right? They thought it was a market of, this is something that some executives and stuff, they did not imagine this as being something that's used by the masses. And then it became much bigger. Mm-hmm. And so that, of course, ruined the business for them. And there's a bunch of examples of that in history, where you had a case where by the market being much bigger than you ever expected, actually it can kind of ruin it for the company that's the current leader. That's a pretty common way that it happens. You have this leader who's a leader in, like, quality and things like that, and then someone comes in with cheap. And normally, if someone comes in with cheap, that won't kill you if it's a pretty settled industry. Like, if you have a lot of quality and all they've got is cheap going for them, that might not help them a lot. Uh-huh. But if cheap is enough to really grow to 10 times more people using this product, to 10 times, 100 times more people in this industry, then it changes everything. And the economics of it all change. So what do you have there for the operating margins?
We got operating margins. I mean, 2006, there were 20%, and then 26%, 28%, 25%, 22%, 23%, and then 10%. And then revenue declined, and it was -8, -59, -5, -21, -32, and it's just been negative ever since 2012.
A lot of these things are hard to judge because I also knew some people who had BlackBerries. And to this day, I've not seen the same amount of loyalty that anyone has.
No, everyone just has
in terms of their obsession with it, as they did with BlackBerry. And yet they use iPhone today, those people.
It's the ecosystem. It all works together.
Yeah, well, I mean, now you don't have a choice, because if you want apps and things like that, you have to have a smartphone. It has to be an iPhone or
Jeff, you can't just walk around with a flip phone anymore.
An iPhone or an Android to do anything.
You say to hell with all of that. I'm just gonna have no phone.
And Apple had the opposite. I mean, when Apple was, when I was growing up and stuff, if you wanted to play video games and things, there was no point in having Apple products, because they weren't going to develop it for it the way that they did for PC. Mm-hmm. So it's just that, once you achieve that kind of scale,
gamers hated PCs or hated Macs. I believe they still do, but I think it's gotten better.
Yeah. So how fast were they growing though?
They were growing, 50%. 99%, 84%, 35%, 33%. So huge, fast. And then obviously operating income, net income, everything.
Right. So the problem, of course, is that they went to 1 year of, what was it, like down 8% or something? Is that the first bad year I see?
Yeah. Mm-hmm.
But after that, they're down like 30%, 50%, whatever, for
ever
5, 6, 7,
2020.
Yeah. So they go from growing, like 50% a year. Research and Motion was at the time. Mm-hmm. So for 5 years or so in a row, they're growing at like 50% a year, and then the next 5 years they're like shrinking at 50% a year.
Look at that market cap too, right? So peak market cap.
Well, the market cap thing's even worse, because the market realizes what's happening, right?
Yeah, we had 58 billion and then 39 billion, but when they had their first revenue decline, mm-hmm. it went from 34 billion to 7 billion.
Yeah.
Which is down from a peak of 58 billion, according to QuickFS. It could be a timing thing. Maybe it was a little bit higher, blah, blah, blah. But that's pretty crazy.
Yeah. And I also, in that book, you notice that the biggest competitors that they unseated a few years earlier, not at the end there, their biggest competitors at the end are some of the companies that exist today and have a big share. But a few years earlier, the ones that they're taking all the market share from and everything, they also don't have much of any business left either. So the ones that are even as big as them, when you have talking about the Nokias and things like that, it was a matter of them unseating them, and then 5 years later, they're gone as well. It's just a total turnover in leadership in the industry. So, but that's a revolutionary technology that we're talking about. It's the kind of thing like talking about cars or something like that, or the internet, where it's just bigger than anyone could have anticipated. If you had done any sort of market research into it, no one would have ever guessed that it could have gotten as big as it did in terms of how people were going to use it, how many people are going to use it all around the world. That, you just wouldn't assume that the addressable market could possibly be as big as it turned out to be. And that's why it's hard to know a lot of times. And too big an addressable market is often the reason why you end up with companies turning from being extremely profitable to losing a bunch of money.
I read something which I think actually was from this book, which is what prompted me to buy it. They said that Buffett became really interested in Apple. I think it was Sandy Gottesman left his phone in a taxi. His iPhone in a taxi, and was like super like, oh my gosh, I can't believe I lost my phone.
Yeah.
And I think Buffett was like, really? Like, he cares that much about it?
Mm-hmm.
Maybe I'm missing something here.
Yeah.
So read the book after Steve. We'll talk about it on the podcast. How long we've been going? We've been going for a long time. 2 hours and 3 minutes. We always say we're going to aim for an hour and a half, but I don't think we've hit that yet, which is great. Do you have any final thoughts for the podcast this week? People seem to be liking the longer format.
Okay.
They said, I don't care if it's longer format. I just want consistency.
They mean coming out with it on this. Yeah.
But most of the feedback has been they like the longer format.
Yeah. So we talked about growth stocks this time, I guess. People could ask questions that they might have, and then we could do more around those kinds of things. So if they have questions about a particular one that are in the episode, growth things are not really one that I'm qualified to talk about much. We've certainly bought lots of companies over time that have grown their earnings per share by a lot over a long period of time, and that the stocks have done fine. Well, okay, let's see. How far does our record go back on Activision for QuickFS? That's the company I talked about. I'm trying to find anything that has any history of high. So its growth the last 10 years and stuff is not high. But is there any period, if we go back in the, it had a merger and stuff. So if you have to go to the Excel sheet. So I'm not sure if we'll get any record that's accurate from that long ago.
2002?
Does it go back to there? Okay.
Wow, such great software.
So can we go to the ratios?
Sign up. Tell me you came from Focus Compounding. It's like 3 plugs for Quick FS today.
Mm-hmm. So if we go to the ratios, what kind of growth do we have in the early years there?
27%, 10%, 10%. Then a massive growth. 44%, 4%, 3%, 91.5%, 48%, 4%, 7%. I mean, yeah, growth.
Okay.
I don't know what they're doing. Were they doing acquisitions and stuff?
Yeah. So some of that's acquisitions or big merger. So a few things that are interesting, right? Is that what in 20 years, there's only 3 negative years. Am I reading that right? Where's the growth, the revenue growth rate? Yeah. Something like that. Mm-hmm. And gross profit is not much different. They're both pretty similar that way. So vast majority of years you're growing. Actual growth rates are not particularly high. But they're always positive, and then they're somewhat high in certain periods. But I don't know, how much would it be thought of as a growth stock?
No.
But we talked about it. It's like 100 bagger, since, what is the period here? It gives you the prices from then to now. So the period that we're looking over is not 100 bagger, right?
No, we go back to 2002. It was
okay.
1.6 billion.
Oh, no, don't worry about that. Look at the price. Does it have the price?
Per share?
Yeah, you need the per share to do this. It's one below it.
Yeah.
Period end price.
Period end price. Yep. $3.73.
So 20 times return?
Mm-hmm.
Yeah.
And then if it gets taken on it. Yeah. Well.
So I don't know. So apparently even this one is not good enough to qualify as a growth stock.
I don't know. I think growth stock, ARC innovation type stuff.
Well, your operating margin, tripled? If you look at the earnings per share, first of all, I'm worried about earnings per share. So I think often it's not a growth stock in terms of, we're often, when you're talking about ARC and things like that, those are the reverse.
Yeah.
They issue shares and stuff over time.
Yeah.
Right.
And still burn cash.
And so as a result, they grow even, but what I mean is you have to grow your actual earnings faster than your share count just to get your EPS to that level. I don't know. When I talk about growth things, at most I'm talking about things that are only in the category of like Buffett type growth, which is he hopes to find something,
modest growth.
He's talking about even back in his partnership years, a Disney and American Express, things that might grow every year almost for 60 years.
It's just funny though do people talk about Apple as not being 12%, 13%? That's growth.
But it's very slow compared to the other. Isn't it the slowest of the FANG type
companies? It's profitable growth. Yeah, we want to talk about Meta. Okay.
Much higher growth.
That's
very high growth.
Yeah, that's crazy.
Yeah,
that's crazy.
And
for people listening, 10-year CAGR 41%. And honestly, it's only sped up. It's been pretty damn high growth all along.
Yeah, that's what I mentioned in the article that I wrote about it. Was Meta is one of the examples of something that's hard to so Google, Alphabet, it's not that. So if we're talking about EPS and stuff, it's not very different from over-the-counter markets, actually. Okay, it's a little bit better over the last 10 years. However, it achieved in a very different way, which is having twice as high revenue growth, but then the margins aren't improving so much, and the share count isn't coming down, those sorts of things. And so it doesn't convert into quite as much. So your earnings per share growth isn't as impressive. We've bought things that probably have grown their earnings per share 20% earnings per share growth over 10 years is possible. We've bought things like that. But I don't think I've bought things that ever had 20% revenue growth over 10 years. So they had to have achieved earnings per share growth without that
efficiency.
Well, Buffett did that with the railroads. Yeah, he did that with the railroads, where they were high. If you were looking for earnings per share growth, if your only requirement for a high growth stock was that its 5 or 10 year earnings per share growth was high, then actually even something as weird as a railroad for a while there would have scored as pretty good, even though it had tremendously low revenue growth and the real business was barely growing at all. But the margins, the operating margins were going from as they improved all those things over 15 years, maybe 10 to 40% or something. It was huge what the railroads changed in terms of their margins. So that's a huge part of how they got those returns. And then they used everything they weren't paying out to service debt and paying in dividends. They bought back their stock, the railroads. Mm-hmm. So that's how they were able to achieve those kinds of numbers. But most of the things we're talking about don't really grow that much faster than like a fast growing financial company or something. So maybe we're talking 10% a year. Let's say nominal. What would you say nominal GDP type growth is that people expect?
5-ish. Yeah.
Okay.
I think, yeah.
Yeah.
5, 6.
All right. So is anything that grows faster than that is a growth stock?
I guess.
Okay. So then we buy things that grow faster than that. Although,
we buy growth stocks.
Yeah.
Maybe it's an industry thing.
We don't invest a lot in emerging
cycle.
Industry. Yeah. No,
it's the
we don't
life
do
cycle
that.
of the company.
No. We don't do any of that kind of stuff, I would say. Over-the-counter markets is not a new industry or even a very new business.
So we wouldn't invest in like an upstart?
No. I wonder what the earliest is that I invested in the history of a company, like from its founding. Like I probably invested in someone which it's somewhat recently gone public. I have done that actually, never an IPO, but I have done things that weren't that long since they went public, but they weren't founded. It's not like they went public shortly after being founded. They would have been public for a long time. So I can't think of, I'm trying to think of anything where it was close. It was remotely early in the life of the company.
Other than a spinoff.
But even if it's a spinoff, I trace that back as like the company's history, So.
Oh, so you're saying like a full-on day one investment?
Yeah, I mean, like Dun & Bradstreet's a spinoff from Moody's. But I think people think of it as being founded 100 and some years ago or whatever.
Yeah.
Those sorts of things. Lots of these things are spinoffs of something else. But I just like as these kinds of companies, right? They're actually doing something new. We can talk about when was Google founded, when was Netflix founded, and those things, and then a few years later, people can buy stock in the company. I can't think of it, but it's got to be compared to most investors that I really don't invest in companies early in their histories. Because I have trouble thinking of cases where I bought something, within 10 years or something of its founding. It's hard to think of any cases where that would be true. It seems almost impossible that I would have done that.
Cool.
So maybe that's the problem, is that to have growth stocks, you have to buy them early on in their history.
I don't think it's a problem. I just think we do it differently. But again, I think it really comes back to the industry and investing in industries where the competitive landscape is more settled. That's the biggest thing.
Yeah, I guess that's true. We own a car dealer though. It's just not Carvana. So I guess they're in the same industry. And if it's unsettled for Carvana, then I guess it's unsettled for them too, Yeah, so I get tons of questions by people about growth things. Is probably, in terms of like numbers, it's the thing I get the most questions about. Like in terms of someone actually saying, how do you calculate? It's always a growth related question. Like wanting to know, okay, so what price to sales can I pay? What growth rate do I need? When it comes down to something where they want an actual formula, it really is growth driven. I don't get questions about formulas and things like that for other sorts of investment things. It's not like they say, well, if interest rates are X, what is the right P multiple or something? I never get a question like that, even though you'd think that would be common too. It's always questions about like growth and how much can you pay up for growth and how fast does growth have to be mathematically for something.
So if interest rates are 6%, what's a fair multiple for a company?
Well, it's fairly easy because 6% is pretty normal for what we've seen over the history of the stock market that we can record. So if we're just going by the historical numbers, then you'd probably expect Shiller P's and stuff in line with the long-term average, which is obviously a lot lower than where we are now. But, we'll see if that...
If we even get there?
Yeah, we'll see if that happens. But
do you think rates have peaked? Do you think they're going to continue to raise? And there's just been so much wealth. I feel like that has so much excess that's come out of the market recently. It feels like we're in a recession, I feel like.
Oh, no, I think you'll get a recession. I mean, I don't want to you'll get a recession at some point, no matter what. But I mean, short of recession, it's not very easy for the Fed to do anything to reduce. I mean, recessions are kind of what gets rid of inflation. That's the kind of the mechanism for doing it. So short of that, I don't know what would be able to solve an inflation problem. In the 70s and 80s, you had several recessions before you were able to get inflation down to the number that you wanted. So I don't think that like just having a recession would be the worst case scenario for what people are worried about. Just a recession, then, oh, good, our inflation problem is solved. I don't think that that's something that people are terribly worried about as being a particularly bad outcome, you know? You'd be more worried about like
persistent inflation.
Well, you'd be worried if you have an inflation that is higher than you would like while the economy is doing poorly. Yeah. I mean, having high inflation when you have like no unemployment is one thing, but if you have unemployment's a few points higher, if you had unemployment of 5.5% or something instead of 3.5%, and you still had inflation that was an uncomfortable number, then people might worry more about it, you know. But look, you're already seeing a big change in like stock market things and stuff, but the Fed, they don't really care about that. I know that the people who buy stocks and things think that they do.
I think they do.
It's not their job.
That's not their job. But
they really, I think they pay far less attention to the stock market than people think that they do.
That's a very cute thought, Geoff.
I think that we tend to think that because they have a huge effect on what we're doing, that they must care a great deal about it. I think as long as it's orderly, they really don't care. So like if a lot of wealth is destroyed for people and that doesn't have a lot of effect on the economy, I don't think that they care. Ben Bernanke cared a lot because he was trying to use the stock market to restart an economy.
Well, he came out and criticized the Fed and said that they waited too long, which is like the golden rule, I guess, of being part of the Fed is not criticizing the Fed.
Even after you've left and stuff? Yeah.
He's probably just trying to sell another book or something.
He came out with another book.
Did he actually?
No, that's the only reason I gave the interview.
Oh, no shit. Okay, so I didn't know that. He's very much like that.
No, like yesterday or whenever the book came out, the interview coincided with the book. Yeah, that's the only reason why he was giving interviews. Yeah.
Go figure.
Yeah, but we haven't. So we'll see what happens. But obviously, we haven't had a quote unquote normal recession caused by the Fed. That isn't a financial panic or a pandemic. I guess we would say. Yeah. In about 30 years. So it's just people are out of practice for that kind of experience, you know, and we'll see what that means in terms of actual results of companies and things. But what it means in terms of the stock market is this is not that unusual for that. For most stocks. Now, the ones that we keep talking about, the unprofitable tech things, it is unusual, but it's not because we're having a bear market or increasing interest rates or whatever that's so unusual about this. It's that we had a decade where those things didn't go down. Normally, you don't keep providing capital to businesses like that for that long, right? The cycle doesn't last that long, so we haven't gotten so many of these, right? So that's the unusual part. But if you threw those companies out, if we were just looking at the performance of companies that didn't include any of that stuff, Buffett. Okay, so Buffett, for the most part, if you looked at his portfolio, right, on Data Roma or whatever, you're going to see something where, right, so those companies have not been down. Their stocks are not down at all, like the things we keep talking about, because he doesn't own any of that kind of stuff. Now, Taylor Tom might own one or two, like recently public. Amazon. Yeah, but it's like almost nothing. So he wouldn't own companies like that. So as a result, it doesn't look like, people are saying, oh, you're already deep into some bear market or something. Well, if you own all NASDAQ, whatever stocks, then maybe you feel that way. But if you own Berkshire's portfolio, you don't, because it shows right here, reported price. And okay, so you're down sometimes 15% or something, but you have to go way down this list to find something that's down 20% or more.
Yeah, and it was a NASDAQ related thing. Snowflake.
Yeah. So like probably a third of his top stocks are up, if we take the top, I don't know, 15 stocks or whatever. And whereas for the market, when you're talking about some of these things that we talk about, they're all down. There's almost nothing that's up since the period. This is March 30. What is it? The reported price is March 31st?
Yep.
Something like that, yeah. So if you looked at another one, I don't want to single out anyone, but there are other ones you can look at on Dataroma. Like there's a Tiger whatever fund and stuff like that. Those things everything will be down 20 to 70% or something. It'll just be all red that way. Whereas Buffett, you don't see that. And it's not because Buffett's some extreme value investor. David Einhorn shorts things and stuff like that. It's nothing like that. It's just that he literally doesn't have any of that kind of thing in his portfolio, right?
Yeah.
So you see the difference. So if you were in this this one here that we're looking at on Dataroma, it would seem like it feels like it's worse than a bear market. It feels like you're halfway through some terrible decline in the stock market when you see this kind of thing. If this was the index instead of being someone's portfolio. But if you own Buffett's, you wouldn't feel that way. So that is the thing that's like similar to the .com period, the busting of the .com bubble and everything that people may not realize is that when you invest in the real value type things, the old style Buffett type things, right? Or whatever, you just avoided the .com mania and some really big stock mania. So Buffett was in a couple of them like that were huge stocks. There's a little bit of mania in those too. But outside of that, you didn't feel like there was a bear market at all. I didn't feel investing that there was a bear market. It was happening around you, but it wasn't something you were seeing in your portfolio. If you look at Buffett's right now, which is a lot of financials and energy and really high quality companies and things that have been making money forever, it's not good, but this doesn't look.
No, it doesn't.
This looks like any random year from the 2010s that you could pick out for a portfolio. Okay, it's up this year, it's down or whatever, but this isn't something where you could never imagine that there was some big bear market or something from looking at his portfolio. Especially you're considering that Buffett's portfolio is probably the top stuff that we're seeing.
Yeah.
The other stuff is probably a little bit more Todd and Ted. And from that portfolio, it's very mixed. I mean, honestly, right? I'd describe it as mixed. There's not a lot that's up a huge amount or down a huge amount or anything. But since that report date that they have there, so the end of March, it just looks mixed.
Yeah.
Yeah.
But it doesn't look like Tiger.
No. And there's other ones too that you could, that's just an really extreme example. But there's plenty of other ones where I saw where there's not a stock that's not down at least 25% of every stock in their top five. Because they're really in those hedge fund trades of the things we're talking about, the very not even just fast growing stuff. They usually weren't making money. They're the Carvanas and things like that, a lot of that kind of stuff. And Buffett doesn't go into any of that, just like he didn't go into the .com thing. So I think that if like what you saw with the Tiger portfolio was what the S&P looked like, then yes. Would the Fed care about that? Yeah. Right. That's highly unusual. And that's showing you some level of stress that's totally unheard of. But if,
it's really excess is what you're basically
if Carvana and Uber and Peloton and stuff are down 90% or something, they're not worried about that, even though that is in a lot of people's portfolios. That doesn't reflect something about the overall economy that way. It's kind of like the .com thing blowing up. It's just something you have to accept that, yes, that they did end up cutting rates and stuff and after that and worrying about a recession and everything. But it was something that just was going to happen. It did happen. And I think they'd feel the same way about those kinds of speculative things, which a lot of the stocks that we see down by huge amounts right now. So I don't think that you're going to see a lot of worry about that kind of thing. If, like I said, it's the orderly thing. I think they care.
That's a good point.
And I think they care way, way more if we see disruptive stuff going on in like treasury markets and stuff, not the stock market. I don't think that they care anywhere near as much. A big decline in the NASDAQ is not going to concern them the way that like the whole repeat of a taper tantrum type thing would be a concern. Yeah.
Cool. Well, I want to thank everybody so much for tuning in with the both of us. My name is Andrew Kuhn. His name is Geoff Gannon. If this is the first time you are joining us, thank you so much. Be sure to check out all the work that we put out on the internet. If you're interested in learning more about our money management services, reach out to me at andrew@focuscompounding.com. And if you want to have your question potentially on the show, email it to me at andrew@focuscompounding.com. Put in the subject podcast, and I group them together, and we'll start to poll them for the show, just like we did today. So I want to thank everybody so much for tuning with the both of us. Hit the subscribe button, leave us a rating and review, and we will see you in the next podcast. Take care.